Here with Mr. Jackson, our economic outlook.
Thank you, Mr. Chairman. Yeah, I'll let Sola pull that up. Thank you. Well, happy to be here. I'll try to go through our economic forecast, and certainly, very happy to entertain questions and discussion as much as needed. I'll start off a little bit with our macroeconomic outlook, and certainly want to spend plenty of time talking about the state of Indiana specifically. But as always, a good bit of what we expect from the state is a function of what we expect at the national level as well. Our forecast of real GDP growth for 2021 was revised up a little bit. We did have pretty strong October numbers in a number of areas that feed into GDP growth. And so that gives some momentum going into 2022. The forecast for 2022 is 4.3% growth. I'll show some of the other numbers are available in the slide deck as well. I don't want to throw too many numbers at you. Those are, of course, that's still, is a good bit of just playing catch up from what happened in 2020. Still some of that overhang, but, certainly plenty of areas of strength in the economy. As I said, in October, we had, particularly exports, inventory investments, which is really inventory rebuilding, which has been tough to do with a lot of the supply chain things going on, but seeing some of that happening in certain areas, certainly not all. So even with some partial reversals, perhaps in November and December, which we are seeing a little bit of now, we still feel pretty good with that upward revision and kind of where things are going. Certainly inflation is an issue that's very, very top of mind. The forecast, of course, again, most of 2021 is history at this point. It's up to 4.6% inflation. Now, we'll say a little bit of what's going on there is that, in some areas, particularly energy, that's, year ago comparisons at this point are going to look high to some extent because of where we were a year ago with some of the prices, but it's still, it's real nonetheless. And probably the bigger thing now is the revision to inflation in 2022 of, the rate up to 3.7%. Supply disruptions, we're already starting to see, some things working through, but there's a long way to go on that. We can talk more about that in specifics if you'd like. The Fed, I think yesterday just had a meeting basically with that, as I understand it, everything coming out of the Fed meeting yesterday was pretty well in line with what we were expecting, seemed to be mostly in line with what the markets were expecting, which tends to be pretty big. And that's always the issue with just about everything is, kind of where things are relative to expectations in terms of interest rate policy in particular. So, I'll just throw that in, some really recent news. Go through this quickly. We assume all of the national level legislation that's already been enacted. Probably, a change from back in when we spoke in April is the infrastructure package that was passed in November. We didn't technically fully have that in our April forecast, but a lot of it was in there already in terms of things that we figured would happen. In terms of the state and local fiscal contraction that we frequently see with downturns, didn't see as much of that this time, both with revenues coming back pretty quickly and with some of the federal money that's been committed along with that. I guess one thing I will say is that there have been some contractions in state and local government employment, which we frequently see with downturns, but I think this one isn't so much from lack of money as with lack of workers. That's mostly concentrated in education-related institutions, which is a big part of that employment picture. So again, I won't say too much more about this. I think a lot of it was covered in the first slide anyway. In terms of the state of Indiana, we certainly look a lot at the states, and how they're doing relative to the national level. Indiana has had a relatively quick rebound. Very few states are all the way back by most measures. Certainly not quite back to where we would have been if none of this had happened last year. Manufacturing came back very quickly, but again was partly a function of what was causing the downturn to begin with. Really allowed a lot of things to come back fairly quickly. In terms of any recent surges in coronavirus cases, that kind of thing, basically we don't. I think the bottom line is we don't really see any official actions happening much of anywhere. Some mask mandates in some big cities. Other than that, we just don't see much. It would be more individual decisions about altering people's behavior about travel. Going out and doing things, that's, very much an individual decision, which, could have some impact in certain areas. Manufacturing, certainly a lot of demand, plenty of demand for manufactured products. That's been the case since, June of 2020. Been no lack of demand. That's partly because of spending shifting away from services, from travel, that kind of thing. People, with the things people can't do, they spend their money on what they can do to some extent. And so seen that, but the manufacturing would be even higher if not for a lot of the supply chain issues. Semiconductors has been a big one that everyone's heard about by now, and we that's just going to take well into and through next year to work through. We do think perhaps the worst is behind us, but that doesn't mean it's all over by any means. But we do see that gradually getting better. Labor shortages, are an issue. We could talk about that as much as anyone likes. I think we have some ideas about what's going on there and what we can see. One thing I'll point out on that is, at least some of this certainly predates 2020. Some of the conversations, things like, trucking shortages, shortages of truckers. I remember having conversations with people about this 5-6 years ago, 10, 20 years ago, honestly. So it's not, it may not make us, feel any better or anything, but I think being realistic about where we are and where things are going, certainly some of these things have been ongoing issues. Certainly things like, aging population, people retiring, that kind of thing. That's been going on, that's been a factor, and we'll talk about that a little more later on. The job recovery has resumed, and we're seeing, one interesting thing is that, a lot of the initial job reports that we're seeing each month at the national level have been rather unimpressive, and then they come back the next month and find out it was better than we thought. Of course, you know how that works. Kind of the initial number gets a lot more attention than the revision does, but that has been working its way up. We had a really interesting situation last month, or at the national level, really, where payroll employment increases didn't look all that great, but overall kind of household employment, as we call it, had a huge jump. And those two should be correlated, but they're not the same thing. That can incorporate things like, people being self-employed, taking freelance work, opening their own businesses. I think sometimes statistically, we're slow to pick up on that kind of thing. So that was an interesting situation. But along with that, we did see a pretty big increase in implied labor force participation also, which certainly is something that we've been looking for. Travel and leisure really is the big thing that's been lacking, I think, with a lot of this recovery in a lot of areas. Certain areas are seeing it. A big one that is a question mark down the road, and our forecast, I think, incorporates this, is certainly business travel in particular. Just as not whether it's travel for, smaller meetings, in-person meetings, things like, trade shows, conventions, that kind of thing just seem to be very slow to be coming back. And that's consequential, particularly for, big cities like Indianapolis, where you have convention centers, that kind of thing, and really rely on that for a good bit of your demand base. So that is something that we still think is relatively slow to come back. And again, just kind of explaining, what's in our forecast. In terms of changes, always try to go over, what the changes have been since we last spoke. Really supply side issues have held back GDP growth a bit from what we were expecting. I'll show in a minute, light vehicle sales and really production, has been a good bit below where we had thought it would be able to be. Wage growth has been higher. Again, we can get into that in a little bit more detail. I know that's a big part of the forecast. It's a big thing that the revenue forecasting team and I talk about is wage growth. Any revisions to the data can be big. There's actually a data revision due out tomorrow. Sorry, I can't do anything about that. I will work with Hari and the team to do what we can to digest that. But there would be problems with me trying to get that data early, I think. In terms of the forecast for 2022 and 23, basically everything is a bit higher, partly due to higher revisions that we saw for earlier this year and for late 2020. Gains in consumer spending are largely focused on goods, which is a lot of your taxable items. They're certainly factoring into the sales tax forecast. I want to go over this quickly, just kind of in terms of kind of that top line jobs number. As I think, most of us know, just want to show a little distribution of where the jobs are and where the jobs are not. Again, this is all relative to February 2020, basically, still down 2.7%. Most of those jobs, as we look at, kind of get into specifics, leisure and hospitality, restaurants, hotels, that kind of thing certainly has been expected right from the start. Administrative, waste remediation is a category of professional and business services. Really, I attribute a fair amount of that to really offices not returning. A lot of folks who, worked in office buildings and provided a lot of support roles for that, whether for specific companies, tenants, or for, overall building functions. Just hasn't been as much demand for that. I think some temp services, partly just a function, certainly plenty of demand for temp services, but just not having the worker availability. Government, I kind of lump that all together. That is mostly education-related jobs, can be staff level, support staff. It can be teachers, all kind of things there. That's another one that's really been shortcoming. One thing I've been pointing out to folks is that health and social services includes things like daycares and nursing care, in-home care, that kind of thing. Daycare is one that doesn't always stand out as you'd expect to be in that category. Some of that may bleed into other services as well. That is almost entirely the shortfall in health and social services. Has been a downturn in nursing care, daycare centers, that kind of thing, just not getting people back. One thing I will say, and well, actually I'll save that thought for a second. Certainly transportation and warehousing been a huge gainer everywhere, and that's largely for shipping stuff, sorting stuff, partly a change in purchasing patterns, professional, scientific, and technical services doing very well, and that, we think is largely future-proof. We like to call that. Manufacturing for the state of Indiana actually has been up relative to, relative to what the nation is seeing. I will say part of that, I think a couple of numbers in there might be begging for some revision later on, but certainly an overall very good picture for manufacturing in the state. Pardon me. This is a point that I want to raise. It's kind of an interesting thing that's been going on. And again, this is one we've been talking about a little bit and also relates a little bit back to the previous slide in terms of the mix of jobs, that most of the jobs that we were showing down toward the bottom as being lacking from a couple of years ago tend to be lower wage, almost entirely lower wage jobs. And so in doing that, even if everybody's still working, makes the same amount of money as they were before, that's still going to pull the average up, right? Just because you're mostly taking out, it's almost all low observations you're taking out of that. So that's what shows that big spike in the red line there in 2020 Q2. Interesting to see that, it actually went negative in Q3. Well, that's, as you start to see some of those lower wage jobs come back, it pulled that back down again, not necessarily anything else going on, other than just change in the mix of jobs. Moving forward, though, we do see that level kind of being, any growth rates from there are moving forward from that higher level, partly due to change in the job mix. I think another aspect that I like to point out with a lot of the lower wage jobs is that, a lot of them can be part-time jobs. Many times you'll have people working, 10 hours a week, 15 hours a week, 2 or 3 different jobs. Well, now maybe that same person really just has one job, but they're working just as much or more. But if you look at their average wage for a job, it's going to be a lot higher because you're not splitting that work among three jobs. A little bit of a statistical point, but it gets important as it's a structural change, in the underlying numbers. And I want to make sure and make that point, as we move forward here, as far as what's going into the numbers and what we expect moving forward. It's just, something different from what we've seen in the past. So we do see that, but, again, we do see growth rates getting back down to more normal levels as you see by 22 and 23. It's just more from that elevated level to begin with. Again, I won't go through all these numbers. These are a lot of the numbers that are going into the presentation you'll be seeing next. A lot of these numbers underlie that. Unemployment rate is getting very low by 2022, 2023, with different things going on with the labor market. You have to remember that lower labor force participation will tend to drive that number down, all else equal. But probably what it does signal is just that it makes it more difficult. It makes it more work for employers to find employees. Basically, is kind of the main significant thing there. We'll point out briefly that it's interesting to see the disconnect in wage income and personal income in 2020 and again in 2022. That factors into some of the forecasts that big jump in personal income when wage income wasn't going very far in 2020 was all really various stimulus payments from the government making up that, really more than making up that shortfall. And then personal income really, or a lot of that spending leveled off in 2021 relative to 2020. Then 2022 is the big year where we see that pullback in the in the federal money going to individuals, and so that's what pulls down that personal income while wage income is still growing quite substantially. And that shows a lot in the personal consumption expenditures number as well. Labor force participation, I don't frequently run graphs back to 1980, but I wanted to in this case just to illustrate a larger point, which is that labor force participation really has been going down ever since the late 90s. Really, a good bit of that is you kind of had a leveling off of the contribution that you had from women having a much higher labor force participation rate, really, going from the 60s or 70s into the 90s. Not to say that went away, but, kind of, again, just statistically, that effect leveled off over time. And so now, that may be pulling back just a little bit, and that was actually offsetting, moderate decreases in labor force participation among men over that period. Now we're getting into periods of, aging population, that kind of thing. And so we see that big drop in 2020. Part of the point there is that we do see that coming back some. It's already back, but we certainly don't see it getting back above where we were prior to the pandemic. If anything, it's going to be slightly lower. Again, we have, still have, aging population. One of the big things that we're seeing, is coming out in the numbers is a lot more retirement in kind of that 55 to 65 age range. Folks who are able to do so, they're just not in the labor force right now as much as they had been. So we see some of that coming back, but not entirely. And that's partly just because people can afford to do so. Now, having said that, with a lot of this thing, what we probably will find moving forward is that some of the folks who are currently out of the labor force will find that they can't afford to stay out of the labor force, and will need to come back in, whether they quit a wage-paying job to start their own business, thought they had enough savings, different things. Some people may be waiting more for the pandemic to blow over more fully, if they don't have a job where they can work remotely, that sort of thing. So we do see some of that. Realistically, we see some of that coming back, and that, I raise that point because it's a big factor in the forecast moving forward nationally and for the state of Indiana. Certainly lack of child care and senior care has been an issue for some people coming back to the labor force. In the short run, we see some of that getting better, but it needs to get more better in order to get more people back in the labor force. Just throwing out this number, partly it's a relatively new data set available. These job openings, labor turnover survey has been available from BLS at the national level for many years. They recently started releasing these at the state level just in time for some real, kind of record observations in some areas, particularly in terms of the job openings rate. We've seen all kinds of statistics about, job openings being much higher than basically the number of, people officially unemployed. Of course, that number of people officially unemployed does not include people who aren't being counted as part of the labor force, but who still are there. They're still here. They're just not being counted. So, that's, then it becomes just a matter of getting those folks, perhaps back into the labor force, or employers finding other ways to get the work done with the people that they have. So, again, out of this whole thing, probably the job openings rate is just much higher really everywhere. These numbers are for the state of Indiana, but it's pretty similar across the country. Housing starts, I won't say much about this. We have seen, a big rebound as we see in 2021. One reason I show this at this point really is that as we look at the inflation numbers, one number that's really starting to stand out as part of the CPI and inflation is the cost of renting homes. We know the housing costs and all that are going up, but that line item is playing a much higher role in overall inflation than we're accustomed to seeing. And really, as I look back, part of my point here is a lot of this stuff is, in terms of the inflation pressures, are very long-term in nature, really. It's not everything happened overnight. Certainly as we look at, pulling the pullback in housing starts, again, this is for the state of Indiana, but, the whole country is not going to look that much different. We don't necessarily want to get back to where we were in the early 2000s, with some of what came out of that. But as you see, starting in 2009, it never really came back all that much in terms of home building. It was really just a very gradual thing. So, arguably you had a lot of, shortfall kind of building up over the years that you're starting to see now. So, we still see, housing starts, home construction and all that being very solid moving forward. We don't see it going much higher than current levels, really probably pulling back a little bit, but still, relatively healthy relative to what we've seen. But again, I just wanted to provide a little bit longer term perspective on that category. I frequently show this. Again, this slide is normally pretty boring, but some may still find it boring. But one point is to see that little V-shaped thing going on there. That's mostly services that had been going up and up and up pretty steadily, and that's your services. Part of the point there in terms of particularly your sales tax revenues is that those services tend to not be taxable items, and so to the extent that is a higher portion of your total spending, that cuts into your and that cuts into good spending. But we did see a big bump. We don't see a big pullback in good spending moving forward, but we certainly see lower. We don't expect recent rates of growth to continue. We'll probably see a bit into 2022, partly just pent up demand for things that people weren't able to get, and is probably in my next slide here. Yes, this is one that if you compare this to this is auto sales. I always show this one because auto manufacturing, and this includes SUVs and light trucks. It's a big part of the manufacturing picture and the economic picture for the state of Indiana. One thing that this slide back in April did not feature, as you look at that little time now line for 2021, that second V, we really were not expecting as much back in April. That's that second pullback. The initial one, clearly, well, that was 2020 Q2. Again, these are quarterly unit sales, especially right now, pretty highly correlated with production. We do see that coming back. So again, we see plenty of demand base for cars and especially light trucks and SUVs. SUVs are in that light truck category. So we really see that coming back, and plenty of pent up demand being satisfied really for the next 3 or 4 years. But it will take that long to, if it weren't for production shortfalls, we'd see a much bigger rise in 2022 probably, and then more of a pullback. But we think just kind of by necessity that will be a little more leveled out. So again, I don't want to spend much time on this because it's all a rehash of what I've said. It's a little overview. Again, certainly things like labor force participation, inflation are probably the two big issues that I can think of right now in terms of kind of risks and things driving where we are right now, and potential things to talk about for the forecast moving forward. We do see supply chain issues gradually getting better. Nothing's going to happen quickly. And the only other point I'll raise with all of this is that there's still plenty going on. I think sometimes we hear so much about supply chain issues that we think just nothing is moving, right? Nothing is happening, and that's just not true. I mean, even with port backups, they're really moving, record product through. I drive back and forth across the state of Pennsylvania and Ohio a few times a year. I've never seen so many trucks on the road as I've seen the last few years, or, as I've seen the last year and a half. So things are moving. It's just not as much as, needs to kind of get caught up. But, just trying to really illustrate the thinking that goes on behind the numbers that you're seeing. So that's.
Thank you, Mr. Jackson. Welcome back to Indiana.
Thank you.
How does Indiana compare to the region and some other states? Are we average? Are we doing better than some of the other states? How do we compare to our neighbors?
By most measures, you're doing better in terms of, population growth is a starting point. That's one thing that I didn't even get on my spiel about today is population growth has been relatively high. I mean, relative to the nation, relative to western states, southern states, doesn't compare as highly, but relative to immediately neighboring states, Stark's population growth is doing better, but most measures of economic growth are doing better in the state of Indiana. And if I may, I will mention that, I just read the other day that production of recreational vehicles, most of which come from northern Indiana, is really at record levels in 2021, expected to be a bit higher in 2022. And that's even with, maybe they don't put computer chips in those, I'm not sure, but I guess they do. But, we'll throw that out as an interesting statistic that I came across.
Senator Cadora.
Thank you, Mr. Chair. I appreciate the presentation. I just want to confirm that I heard a couple of things that you said correctly. So I think among the common themes across the presentation, I heard you talk about living wages. I heard you talk about childcare. I heard you talk about affordable housing as critical factors that have a correlation to labor or workforce development. Is that accurate or fair to say?
Particularly the daycare, senior care thing, yeah, but it all factors in, yes.
So to peel the onion, if you will, just for one more layer. So you're saying if we invest more in childcare, we will be able to bring more people back into the workforce. Is that correct?
I think that's part of the idea, and yeah, to the extent we do hear cases where some people aren't in the labor force now because either they can't with what they make they either can't pay it or basically wouldn't come out far enough ahead. But another factor right now is labor. It currently is just availability. Period. It's more can't find it at any price to some extent. So yeah, I mean that would be one thing that would help to allow people to get back into the labor force. Certainly from what we're hearing.
Sure. Two more quick questions, if you don't mind. Have you seen an increase or expedited investments in innovation and automation as a result of the shortage of workforce?
That would be more anecdotally. Probably haven't seen too many statistics on that, but yes, and that's really at all levels. Certainly in manufacturing, we've already been seeing a lot of automation. That is factoring. Warehouses are a big one where more and more we're seeing investments in robots running up and down the aisles. It can be things like sitting at the sitting in a restaurant, and some of this already existed, but seeing more ordering, not necessarily seeing anyone except the person bringing your food at a restaurant. So it certainly is factoring more into those into those areas that we haven't seen as much before. But yes.
Great. And my final question: prior to COVID-19, according to research conducted by Brookings Institute and the American Enterprise Institute, they ranked Indiana as 42nd in the nation on workforce development. It's called the Indiana GPS project. Have you seen, you mentioned that if the aging population, and if I heard you correctly, you said if we can't produce enough workers in Indiana, we need to consider importing labor. I thought I heard you use the word import. Do you mind if you elaborate a little bit more on that?
Well, I think it was in my, probably in the slides more. That is one issue that I didn't really mention. But, one thing that we are seeing in Indiana and across the country, part of what's been going on with the labor force is that we have seen, a pretty big decline in the number of, in immigration numbers, and most of those people, do go into the labor force. So that, again, is probably one of those factors. I said that, many of the things going on with inflation and all these issues have been kind of slow building issues. And I think immigration does play a role in that in terms of overall numbers. I think especially mostly for, northern tier states, in the country that ends up being a big area, has been a big area in recent years of filling in that labor force.
Excellent. I really appreciate it. Thank you, Mr. Chair.
Senator Brown.
With respect to inflation and costs, I did point out, and I always am a little dismayed on how those numbers. Employment seems relatively low. It doesn't count the people who are.
Correct.
And so, do we have a sense of how many thousands of people were in the workforce or people not to work?
We do have that number. If I may follow up on that a bit, what we probably don't have a good feel for, and I can look for some of this, and I'll do what I can to get it back to you. What we frequently don't have as good a feel for is why they're not working. And it can be a lot of different numbers. In some cases, we can guess. We think we can guess, but we can come up with some numbers of able-bodied people of prime working age who are not in the labor force. Yeah.
Right, which is a concern when we get back to wages and childcare, which has been an issue in the past, is at the same time when some childcare facilities, as I've encountered those owners and workers, were forced to shut down, then they couldn't provide childcare, and then thus some of the workers affected using that system. So it's like this whole trickle effect. And so, and then in that labor pool, the cost of wages, which have taken somewhat of a bump, maybe temporarily, is also a problem as inflation now is eating into those higher wages. So to your point, then you're making that decision. And if a lot of opportunities for childcare have shut down and can't afford to come back, then again, inflation eats into your wage increase, and then you have to make those hard decisions, right?
Yes.
And then I have one question. In terms of your slide on the labor force participation and how significantly it's dropped, and I think you said you didn't see it coming back significantly past the low 60 percentile. So is there, in terms of the actual population of the U.S. as it's aging, because that's what we keep talking about, and I think it is, right, statistically aging. So is there a concern then as we look at this and how we needed a lot of workers to sustain our programs, to pay taxes, to continue the programs we currently offer on the federal state? Is there a concern that we're not going to have enough of a labor force in that age grouping, and or if more of them continue to drop out? I mean, is that too far forward thinking? Does that make sense, the question?
Oh, it makes sense. It's, the main thing I will say, to that on a macro level is that as part of our forecast, we do see, kind of whether we're looking at our population estimates going forward, which we've actually revised downward a couple of times in recent years, basically just on what we've seen, whether it's lower birth rates, that kind of thing, a bit higher mortality rates in different age groups. We do see that, that has really lowered our measure of potential GDP. I will say that now, there are ways to make up for that in terms of automation, that kind of thing. But, also partly to your point then, robots don't pay income taxes. either, right? They don't pay into Social Security and that kind of thing. So, you know, that raises a different issue that is probably for a hearing after I'm gone.
But those robots do pay business personal property tax. All right, thank you very much.
Thank you.
Next, we're going to have Krista Ricci and Hari Raza Damanana. I didn't get it? Damana. Yeah, man. One of these days. I will say this, after the Medicaid forecast, just so everybody here knows, we're going to take a 15-minute recess before Chris Johnston starts.
Okay. Good morning, Mr. Chairman, members of the State Budget Committee. My name is Krista Ricci. I'm the Senior Fiscal Analyst for the Senate Republican Caucus, and I'm joined today by Hari Raza Findramanana, Assistant Director of the Tax and Revenue Division of the State Budget Agency. First off, I wanted to give you a little background. Most of you are aware of this, but particularly for the general public to understand our revenue process and how the state of Indiana forecasts our revenue. The Revenue Technical Committee, it's that large box in the middle of the slide, is a 6-member committee and contains members of both the legislative and executive branches of government, much like the Budget Committee itself. Besides Hari and me, the members of the committee include Eric Gonzalez, Fiscal Analyst for the House Democrats, Ben Tooley, Director of Fiscal Policy for the House Republicans, Susan Preble, Fiscal Analyst for the Senate Democrats, and Dagny Falk from Ball State University, who's the committee's independent economist. The purpose of the committee is to select the statistical equations that will be used for each tax type in order to forecast state general fund revenues for the current biennium using economic variables provided by IHS Markit, who you just heard from this morning. The committee has support from Hari's team in the Budget Agency, the Legislative Services Agency, and many of these individuals are here today. All of their assistance is vital to this process. I would like to thank each of the State Budget Committee members for their continued support of the committee's independent, nonpartisan, and collaborative process by which Indiana forecasts general fund tax revenues. This process has worked very well for the state of Indiana and has been in place for many years. Most importantly, it's considered a consensus forecast, which means all of the members of the Revenue Technical Committee agree that this forecast is our best effort at projecting state general fund revenues for the current biennium. I wanted to give a quick review of the major revenue sources year to date through November for state fiscal year 2022. As compared to the same period for state fiscal year 2021. As you can see, sales, income, and corporate income tax revenue collections through November are all trending ahead of the April 2021 forecast. The sales tax is 8.1% above the April 2021 forecast, 11.6% above the same period for 2021. Individual income tax is 8.1% above the April 2021 forecast, 15.1% below the same period for fiscal year 2021, largely due to changing the filing deadline from April 15th of 2020 to July 15th of 2020. Corporate income tax revenues are 52.9% above the April 2021 forecast, 16.9% below the same period in 2021. Again, this is largely due to changing the filing deadline. Total general fund revenues year to date is 9.6% above forecast and 0.9% below the same period in 2021. And like I mentioned, for income taxes, total general fund year-over-year comparisons were impacted by the delayed income tax filing deadline. As we look at this forecast, there are several economic conditions that we need to consider as outlined on this slide. Mr. Jackson touched on many of these. These are the broad economic trends that are driving the outcomes of the forecast. This slide contains major tax policy changes incorporated into the forecast. The revenue models themselves forecast the tax base for each tax type. After the tax base is forecast, the actual amount of revenue is adjusted for changes made to tax rates and other policy changes made by the General Assembly. The out-of-model tax policy changes incorporated into this forecast include the ongoing corporate rate reduction and FIT rate reduction and the gasoline use tax distribution change through the state general fund portion, which continues to decline. At this point, I would really like to recognize Hari and his team for all of their hard work, as well as the Legislative Services Agency. These individuals have spent a lot of time and worked really hard this summer and fall, digging deep into each equation and coming up with improved models. This slide summarizes each of the major revenue models and variables within those models to achieve the forecast in the largest 3 state general fund revenue sources. For sales tax, we separate into 2 equations. The first is the gasoline use tax, and then the remaining sales and use tax. Individual income tax, we look at separate equations for estimated payments and withholdings. And for corporate income tax, we have 1 equation forecasting corporate adjusted gross incomes. Once again, this slide represents all of the variables in each equation. And as a reminder, the committee selects the equations and the data for each of these economic variables, which are provided by IHS Markit. I would like to briefly walk through a couple of the changes that were made to the models. Regarding the sales tax net of gut model, the current model is a proxy for the sales tax base and spending on durable goods, as well as some taxable services. Overall, this is a similar model as the April forecast, but in order to better account for the impact of the stimulus, the committee added the prior year savings variable to capture the economic activity in terms of transfer payments and the timing of spending. Regarding the individual income tax model, there were no changes made to the withholding tax model within the estimated payments model in order to better capture business incomes from capital gains, and the inclusion of the Wilshire 5000 Common Stock Index was added. The corporate income tax model had a couple of changes. The prior model primarily used U.S. variables. The model was changed to better align with Indiana specifically. The model changes align better with business revenue volatility and strong market growth. Changes include using the gross state product as a measure of the state's economy, including the S&P 500 index to capture business revenues and the stock market activities, and including Indiana gross state product to U.S. gross domestic product as an apportionment factor reflecting how much of the national economy is attributable to Indiana activity. This slide highlights some additional out-of-model adjustments that were needed to ensure the forecast was accurate by incorporating revenues that are not captured within the model themselves. These include the market facilitators legislation and the Wayfair Supreme Court decision and all others listed on this slide. The committee wanted to highlight a couple of economic trends that are driving this economic forecast. For example, wages and salaries are projected by IHS Markit to increase in 2022 and 2023, which is the driving force of the individual income tax withholding model. In terms of wages and salary growth rate over prior year, the growth in 2022 is estimated to be higher than 2023. But again, both years are estimated to grow over the prior year. In terms of Indiana personal consumption of goods, which is the driving force of the sales tax model, in 2022, PCE is forecasted by IHS Markit to have strong growth and then flatten in 2023. In terms of Indiana PCE goods, which is the driving force of the in terms of the PCE growth year over year, this means strong growth in 2022 and then lower growth in 2023 as compared to 2022. So now for the moment everyone's been waiting for. I'm going to go through all of the major revenues by type, and I'll go over the dollars and percentage change for each. In 2020, for the sales tax in 2022, the December forecast is estimated to grow $941.3 million, or 10.4% over prior year, and the December forecast is adding $939.6 million, or 10.4% compared to the April forecast. For 2023, The December forecast is estimated to be $73.6 million, or 0.7% less than 2022, again driven mostly by the trend in PCE goods forecast. The December forecast is adding about $574.1 million, or 6.2% in 2023 compared to the April forecast. For individual income tax in 2022, the December forecast is estimated to be $393.4 million, or 5.2% less than the prior year. As I will touch on later, this is driven by the deferred income tax payments received in fiscal 2021 instead of 2020 due to delaying the tax deadline. In the December forecast is adding $427.5 million, or 6.4% compared to the April forecast. For 2023, the December forecast is estimated to grow at $440.8 million, or 6.2% more than 2022. The December forecast is adding about $612.5 million, or 8.8% in 2023 compared to the April forecast. For the corporate income tax, the 2022 December forecast is estimated to be $41.5 million, or 3% less than prior year. Once again, this is due to the deferred tax payments. The December forecast is adding $459.8 million, or 52% compared to the April forecast. For 2023, the December forecast is estimated to be $62 million, or 4.6% less than 2022. The December forecast is adding $222.9 million, or 21.1% in 2023 compared to the April forecast. For gaming in 2022, the December forecast is estimated to grow $54.9 million, or 13.4% above prior year. The December forecast is adding $50.7 million, or 12.3% compared to the April forecast. For 2023, the December forecast is estimated to be $6.1 million, or 1.3% less than 2022. The December forecast is adding $16.5 million, or 3.7 million in 2023 compared to the April forecast. For all other taxes and revenues, in 2022, the December forecast is estimated to be $18.4 million, or 1.8% below prior year. The December forecast is estimated to be $4.2 million, or 0.4% less than the April forecast. For 2023, the December forecast is estimated to grow $30.3 million, or 3.1% more than 2022. The December forecast is adding $12.9 million, or 1.3% in 2023 compared to the April forecast. In total, general fund collections in 2022 are estimated to grow $542.9 million, or 2.8% above prior year. The December forecast is estimated to be $1.8735 billion, or 10.4% above the April forecast. And for 2023, the December forecast is estimated to grow $329.4 million, or 1.7% more than 2022. The December forecast is adding $1.4387 billion, or 7.6% in 2023 compared to the April forecast. And here's the chart everyone is used to seeing. This is a compilation of the numbers that I just went through, and I wanted to highlight that the total general fund year-over-year growth for 2022 is 2.8% when you compare total fiscal 2021 revenues. However, please recall that, again, the 2021 revenues include about $900 million of deferred income tax payments that should have been received in 2020. So when you see negative growth on this slide for individual and corporate income taxes for 2022 compared to fiscal 2021, and the smaller general fund year-over-year 2.8% growth in the gray bars, that's the reason. But when you look at the tan or like the yellowish colored bars from for 2022 that adjust for the deferred income tax payments and put them back into fiscal 2020, the year they should have been received, the 2022 year-over-year growth is 7.7%, which is more in line with the trends of the economic forecast. And then this slide just highlights the annual growth rate adjusting for the deferred income tax deadlines. The remaining slides are appendices containing trends of model variables. And I also wanted to mention for our viewing public and people here in the audience that all of these documents are available on the Budget Agency website, and Hari and I are available to answer any questions you may have.
Questions? You're so thorough, there's no questions. All right, well, thank you very much. Next, we're going to have Zach Jackson, Budget Director. He's going to go over the combined balance statement.
All right. Well, thank you, Mr. Chairman. With the completion of the revenue forecast, the budget agency has posted not only Tom Jackson's presentation, but also Krista and Hari's presentation on our website. That includes an updated surplus statement on our website as well, and just wanted to take a moment to walk the group through that surplus statement. There are technically two documents, actually three that we'll post, the surplus statement, the combined statement, and then a notes document. I'll probably just walk through the first one, the surplus statement itself. And so just compared to the last surplus statement that the budget agency issued, which would have been with closeout of fiscal 21, the areas that have changed, obviously the new revenue numbers for FY 22 and 23 have been loaded in. Another thing, whenever we put that surplus statement at the end of the fiscal year, there were a number of outside acts affecting revenues or provisions in the back of the budget bill affecting revenues. Those have now been built into the forecast, and so that there would have been a line here previously mentioning outside acts or 1001 changes. Those have now been included in the updated revenue forecast. Looking at the expense section here, I don't believe any changes have been made regarding appropriations or reversions or augmentations that we're thinking might happen for this fiscal year or next. Next up on here is, I think when the budget passed, we were assuming annual surplus of in the $500 to $600 million range for each year. Obviously, with this forecast, that goes up significantly. And so the surplus for this fiscal year is now estimated to be, projected to be this 2.56 billion number for the first year, and then approximately 2.1 billion for the second year of biennium. Going on down through the document, just a couple things. Now what I call below the line, so once we get past the surplus numbers, the one-time uses of our reserves or one-time revenues going in. Just a couple things to point out here. Based on the Medicaid forecast that you'll get in a few minutes, we revised this 214.5 number, which is the Medicaid reversion for this fiscal year. It was a little bit lower in our last Medicaid forecast. A couple things to point out. The excess reserve transfers, and so at the end of the biennium, we were to look at our reserves in excess of 12.5%, and those amounts get split 50-50 between the automatic taxpayer refund and the pension stabilization fund. Equal amounts of $545 million going into both, and I think there was an announcement yesterday regarding the amount of the automatic taxpayer refund. Also, there were one-time provisions in the excess reserve calculation in statute for fiscal year 22, basically saying whatever amount is in excess of 2.5 billion at the end of this fiscal year will be transferred also to the Pension Stabilization Fund for the pre-96 teachers plan. Right now, you can see that we are projected to close this fiscal year with $5.1 billion in the general fund combined reserves, and so the excess of above $2.5 billion would be approximately $2.6 billion, and so you can see here in the second year of the biennium where we are we would be planning to make that transfer over to NPERS after we close the books for this year. Really, I don't think there's much new information on this document other than the updated revenue forecast, but I'm happy to take any questions, Mr. Chairman.
Questions for Zach? All right, thank you.
Pleasure.
Next, we have the Medicaid forecast, Allison Taylor and Rob Damler.
Yeah, go ahead.
Thank you.
So you just go and down.
Up and down. Okay. Thank you. Thank you. Is red on, Senator? Yeah, okay. Chairman, thank you for the opportunity to be here. My name is Allison Taylor. I am the Medicaid Director for the Family and Social Services Administration. Today we are presenting an updated Medicaid forecast with data through September 2021, reflecting projections through state fiscal year 2023. In this forecast, the federal public health emergency remains, and we see Medicaid enrollment continue to grow. I'm going to hand it over to Rob Damler. He's our consulting actuary with Milliman. He will present the forecast, probably starting first with enrollment, because it is a key component to the forecast. And I'll hand it over to you.
Thank you, Allison, and good morning, everyone. Again, my name is Robert Damler. I am a principal and consulting actuary with Milliman, and I'm a member of the American Academy of Actuaries and authorized to present the information here. As Allison indicated, the presentation, I'm going to actually start on slide 6 of the presentation, focusing on membership and enrollment. Our projection does assume that current public health emergency is through January 18th, I believe it is, of 2022. So the public health emergency we have assumed will end on January 18th. The maintenance of effort will end following the ending of the public health emergency. So the enhanced federal match, which we'll talk about in a moment, which is 6.2%, will go through March 31st of 2022 with the ending of the public health emergency. So to the extent that the public health emergency changes, the maintenance of effort would be extended as well, and our enrollment projections will change. What I would like to illustrate here with regard to the public health emergency, in the maintenance of effort, we have definitely seen enrollment growth. Our primary enrollment growth has occurred in the Healthy Indiana Plan, which is shown here. Prior to the public health emergency, we had on average about 400,000 Healthy Indiana Plan members, which included the expansion populations, the adults, pregnant women, and some presumptive eligibility. That has grown today to approximately 700,000 lives. So during state fiscal year 2022, we're estimating 700,000 Healthy Indiana Plan enrollees. That is our largest population growth during the public health emergency. Following that, we do anticipate about half of that growth will go away through redeterminations and re-enrollment into the Medicaid program. The next population that's illustrated here is our Hoosier Care Connect population. These are individuals that are primarily disabled and non-dual eligible. So they only qualify for Medicaid. They do not qualify for Medicare. We have seen some enrollment growth there. Prior to the public health emergency, we had about 90,000 enrollees on average during fiscal year 19. That has grown to about 100,000 enrollees. And then finally, on this slide, the Hoosier HealthWise population. Again, these are primarily children, some pregnant women, and CHIP program enrollees. We have seen some growth in those populations as well. That growth has gone from 600,000 to close to 800,000 lives today. So those are our three primary growth populations that we've observed in the public health emergency. On slide 7, we do still have some individuals that are fee-for-service. We have those that are institutionalized. Those would include those in a nursing home or in the IMD facilities. You can see that we have seen decreases in the institutionalized populations from just under 35,000 to just over 31,000. We do anticipate that that has leveled off a little bit and will slowly increase again in the nursing homes, but not to the levels of pre-pandemic levels. Our home and community-based waiver populations, those have been growing as an alternative to institutional care. And then finally, we do have several fee-for-service populations, dual eligibles, Medicare savings programs, limited benefit populations. So in aggregate, prior to the pandemic in FY19, we had just under 1.5 million lives enrolled in the Medicaid program. We are projecting it to peak on average to just over 2 million lives, and then decreasing with the end of the public health emergency in fiscal year 23 to just under 1.8 million lives. So this is really the driver of our growth.
Representative Brown.
Do you think you'll get back to the 1.4, 1.5?
Not at this time. We are suspecting that about 50% of the population will remain on Medicaid following the end of the public health emergency is our best estimate at this point.
How come?
There have been some eligibility changes. For one, the extension of pregnant women to 12 months of eligibility post. That will add some lives. Post-delivery, pregnant women will receive coverage, as well as we have just seen a change in our enrollment patterns, especially in the expansion populations, the amount of growth.
Consistent nationally, right?
And that is consistent nationally with what we're projecting going forward. It is difficult to understand because of unemployment. We have had people leaving the employment rolls and no longer filing for unemployment. So historically, we have looked at unemployment as an example of an economic indicator for Medicaid. But I feel that those numbers are changing with regard to those who are continuing to file for unemployment and have that relationship to Medicaid enrollment. I think it will be, unfortunately, it is our best estimate at this point in time that we'll be able to keep half the enrollment will stay on.
Senator Kadora.
Thank you. Quick question. Back in the day when I was at FSSA, we had the HIP Link program that subsidized premiums for employees who remain on their employer's private health benefits. And that was one way to keep people employed, and then partially reimburse them on their premiums. Did the program change name? Is that anywhere listed here? Is it the HIP? I'm not sure if it's the HIP Bridge or something else, or?
Well, yeah.
So we transitioned away from that program.
Got it.
We do have a different program with a similar concept that is HIP Bridge. And that's a time-limited opportunity, but for individuals who income out of HIP provide a transitional power account to help with
Yes.
those transition costs. So like, as they transition to employer or market, any of those costs. So similar, yeah.
Similar. Appreciate it. Thank you. Thank you, Mr. Chair.
Senator Brown.
Okay, sorry. Okay, I have a question, thank you for the presentation, about the FMAP, the 4.7% from the feds that's going to go away next year, right, for Medicaid?
Yes, for Medicaid, there is a 6.2%.
6.2,
Yes, it is
sorry.
6.2% and will end at, whenever the public health emergency ends, the 6.2 ends at the end of that quarter.
Okay, and so I know you know, because I've sent some questions on, there are a lot of concerns by providers if the increased FMAP will be retroactive, and if you have received conditional waiver to move forward, if you'll continue to use those funds going forward, or will be impacted if you haven't already participated in that. Does that make sense?
Senator, can you say that again?
All right, so they have granted you a partial approval of your plan for distributing the HCBS enhanced FMAP, right?
Right. You go ahead and then I can.
Yeah, so the
explain what
6.2, the 6.2% that I was referencing is related to federal match on the whole Medicaid program, excluding the expansion populations. And that is different than the,
So that is
The American
for
Rescue
the
Plan.
COVID response. I think you are mentioning specifically under the American Rescue Plan that Home and Community-Based Services spend plans. So the states for opportunities to submit a proposal to invest in it, enforce and support home and community-based services. So we have our spend plan is available on our website, and to your point, it does involve, we're able to draw down additional funds to invest and further expand HCBS services. So that is retro back to the start, which April 1st, 2021. And so we are actively developing plans. Our first investment or expenditure under the HCBS spend plan will be provider stabilization grants. And so we are working on the infrastructure there and plan to, in the next month or two, have provider conversations and explain that opportunity. Is that what you're mentioning?
It's part of my question. And so that's good to know because, as I know you know, the providers are very anxious to hear that. So in the next month or two, so that means you'll be going into 2022 to talk about provider stabilization, and then retroactively to April 2021, you will be giving them the 4.7 enhanced.
So they are stabilization grants, not necessarily, it's not a rate increase going retro to the start date. The start date really is when the opportunity to have that enhanced funding started. So that is accruing, right, over time, and we are committing a good portion, about 20% of the anticipated increase in funding under the American Rescue Plan to devote to provider stabilization grants. And so we're going to be sharing the methodology, how that works, how to access it very shortly.
Well, just with all due respect, you said very shortly.
Yes.
You also said 1 to 2 months, and they are very anxiously awaiting.
Yes, and I understand we are working with federal partners. I've been keeping track personally of other states and their progress too. It's kind of a race to build the program, get the infrastructure up, get the methodology done, figure out how to get the payments moving. We are consistent and in line with other states in that we are, I think, really rounding the curve. I think we have the mechanism. We are getting really close. We were waiting on some CMS guidance. There's some mechanics involved in how do you properly account for this money through the federal 64 and some other documents. But I hear you, and we are, as soon as we can. Paul, do you have any more specific timeline? I think.
No, I know the first round of these things, we have indicated, we plan to make this destabilization grant within this next quarter because we want to make them before setting up, communication with stakeholders and stuff on what that'll look like and how they'll be eligible for those grants. But within the first quarter of this next calendar year, then we would expect for these first round of funding to go out to the fund.
And so I'll repeat that because I bet folks couldn't hear that are watching. So our CFO was just kind of confirming that we plan to by the end of the first quarter of 2022, but reinforcing that we are trying to get communication out. We're going to have a couple of webinars on explaining the process, have an FAQ, and all the mechanics to explain to providers about the opportunity and how to access it. So that is coming before March, in the next month or two at the latest.
Okay, and then one more question. So I appreciate the first slide, the disposition of the prior year surplus, and it looks like a significant amount went to DOC for the increased hepatitis C, and then $40 million, right, to cover their contracted services, which is probably a very good thing. But my concern is, as you know, in the last budget, we increased Medicaid waiver services, and at 14%, which seemed a good amount at the time, but of course now with the feds not being able to tamp down inflation, that's not really the increase that is helping those groups. But we didn't do A&D and TBI, chronic brain injury. And so my question is, are you looking with this increased surplus also increasing wages for those two areas? Because we, at least in my opinion, my mistake, didn't increase that in the budget. And are you looking to increase those since you have surpluses?
I'm sorry, can you repeat? Did you say TBI?
The waivers for A&D and TBI.
Yes. I can take that back. I honestly need to confer with my Division of Aging counterparts, but I hear you saying.
Because
increase,
essentially,
yes.
those are also within the home-based services typically,
Yes.
to some degree. But those were the two groups, unfortunately, left out in getting the increase from last year, regardless of this enhanced FMAP. Okay, thank you.
Yes, understood. And through our HCBS spend plan work, we will be evaluating rate methodologies generally, so it will be an opportunity to really explore in more detail the impacts of trying to stabilize provider rates sort of across, because to your point, we have waivers in different divisions, and taking a look and making sure that they are complementary and we provide the right incentives for
Right, and I would
providers,
suggest it's
so
probably not complementary right now since these two were left out, but I don't know. But it would also, when you go back and look, I'd like to know if those two areas, because I think they're fairly small, were increased with the 14%, what that would look like in terms of numbers, the number of covered lives and the actual dollars.
Okay.
Thank you.
We can get that for you.
Representative Porter.
Thank you, Mr. Chairman. Just a quick question. If the public health emergency is extended, what would be the net positive impact on this? And it probably we'll know in the next, week or so if it's going to be extended. So.
Yeah, I don't have an exact number. I can give you an estimate. We can follow up definitely with an estimate. On this slide here, on slide 5, you can see there near the bottom it says extra FFCRA federal funding of 6.2%. Today we're projecting that we'll be receiving $265 million of additional funding from the federal government, and that is for 2 quarters. So every quarter we're receiving approximately $130 million. Now we do have an expenditure associated with that. You can see up above, we have $129 million worth of expenditures, enrollment variance due to the maintenance of effort. So that's a change in relation to the April Medicaid forecast. So we will have additional expenditures if the maintenance of effort is extended. And I just don't know how much would offset. Some of that's probably more in 2023, because if it's delayed a quarter, then the redetermination process of reviewing everyone's Medicaid eligibility is also delayed a quarter. So that just pushes more enrollment into 2023. So most likely, 1 quarter of additional federal funding is about $130 million. We will have additional state expenditures. That value I do not have. We can follow up with you on that. But most likely it will impact greater in 2023 because it just delays our redetermination of Medicaid redeterminations into 2023. Did that?
Go ahead.
Okay, so what I would like to do is go back to slide 2 briefly. I'm not going to dwell significantly on any of these individual values, just hit on some of the high level of the program. So the top half of this slide illustration are our expenditures. The first 3 lines that are illustrated there are Healthy Indiana Plan, Hoosier Care Connect, and Hoosier HealthWise. Those are our 3 Medicaid managed care programs. So we contract with health plans in the state to handle providing care for our members. As you can see, we spend approximately $9 billion a year on these 3 programs. About in state and federal dollars, about $6 billion in Healthy Indiana Plan, $1.6 billion in Hoosier Care Connect, and Hoosier HealthWise at $1.8 billion. The next is fee-for-service. Again, those are mostly our dual eligibles and other fee-for-service programs. Then we have long-term care, institutional care, and community care. These are long-term services and supports programs, which we spend approximately $3.3 billion a year on those 2 programs combined. We have had some fairly significant growth in the nursing home costs. Nursing home reimbursement today is a cost-based structure. Many of the nursing homes had increased expenditures during COVID, increased expenditures on wages as well as real hard costs of care. And so we have seen some fairly significant increases in the nursing home program on a rate per day basis. We do receive we also pay Medicare buy-in for our dual eligibles and have a clawback payment for our Medicare Part D program. Our largest rebate is under prescription drugs and other collections. Most of the $1.2 billion shown there, $1.3 billion, is for pharmacy rebates. We do remove the CHIP program from the expenditure forecast, and then we have other expenditures, primarily the DISH and UPL payments under that program. So our total program expenditures are $16.4 billion in 22 and approximately $6.5 billion in FY23. The primary source of funding is our federal funds. And again, those will decrease in 23, primarily due to the end of the enhanced federal match of 6.2%. Then there are other funds that are supported from the state. And then you can see that our forecasted Medicaid General Fund Assistant need is just under $2.4 billion in 22 and $2.9 billion in fiscal year 23. And then a comparison is also shown there for the appropriation. We are projecting a surplus of $202 million in fiscal year 22 in relation to the appropriation, and about break even, just slightly negative $3 million in fiscal year 23 in relation to the appropriation.
Quick question. So the institutional care, so I look at the numbers, and the number of patients is below the pre-pandemic level, but the dollar amount is still considerably higher than the pre-pandemic level. Why is that?
Again, that's primarily driven by nursing home expenditures. On the institutional side, those are reimbursed at cost, and we've seen some fairly significant increases in cost per day of 10 or 11% in a cost per day range for the nursing home. So While we've had approximately in the nursing home, we've seen a 5 to 10% decrease in the number of residents, the cost per day has increased significantly over this period of time.
Representative Porter.
Thank you. Excuse me. The 469 million on the surplus, there in calculations there's about 215 million that you said that is still 214 million. So where is that? So where are those dollars on page 2? I mean, there's a difference about 2015 and 2014.
Okay, so in 2021, the bottom line shows as $469 million surplus
Right.
in 2021.
Yes.
And then if you look on page 3, it speaks about how the 2021 surplus will be distributed, the third bullet point there.
Okay, but where is it? Is it? He looked at you, Zach.
I'm sorry. Zach.
He looked at you.
Where is the $214 million of the? Where is the $214 million of the $469 million surplus?
Yep, so of the 469. Thank you, if I can, Mr. Chairman. Of the 469.2 at closeout of fiscal year 21, we had a good indication that there's at least some of that money available, so we went ahead and reverted or transferred that to the Medicaid reserve account. We transferred $40 million, as it mentions up there, to through the State Board of Finance over to DOC this year, and of the remaining 214.5, it is still sitting with Medicaid at this point in their federal fund. And unless something changes, our intention is at the end of this fiscal year, we'll move it back to the state fund and then revert/transfer it to the Medicaid reserve account at closeout this year.
So you used the word revert, so it could go back.
Yeah. So the law is a little, I'll say tricky, just as far as how it matches up with law versus our accounting system. But our intent would be to revert it not to the general fund, but to the Medicaid reserve account at closeout this year, like we did with the 214.7 at the end of fiscal 21.
So 214.5 eventually probably will revert back to the Medicaid reserve account.
Correct.
And Representative Porter, just, when you print out the combined balance statement, it is on there.
I don't have it.
Well, I know you have to print it online. It's online.
I'm going by what I see in front. Thank you, sir.
Go ahead and continue.
I don't have a printer next to me like you.
I do think on the on slide 3 we've touched on these briefly. Again, some of the surplus has been transferred to Department of Corrections, some to the general fund from fiscal year 20, and then in fiscal year 21 we just spoke about that, $469 million. Again, part of it was reverted, transferred to the Medicaid reserve account. Another 40 transferred to the Department of Corrections, and then 214 million still available, as just discussed. This slide illustrates state and federal. Again, we're comparing here to the April Medicaid forecast. And the primary change from the April Medicaid forecast is we assumed that the public health emergency would have ended in July of 2021. And again, it's been extended into January. So you can see here, our biggest change in relation to, on a state and federal basis, is enrollment variance due to the maintenance of effort. On a state and federal, an additional $1.3 billion in 22 and $500 million in 23. The capitation line shown there, we have a reduction in the capitation payments, primarily because of risk corridors that were negotiated between the state and the Medicaid health plans, and we'll be receiving a refund based on those risk corridor agreements. About the fourth line from the bottom, there's a stabilization grant funding for $175 million. Again, that's part of the ARPA program to receive enhanced federal funding. So this is on a state and federal basis variance, but on a state share basis, Most of the population, again, is under Healthy Indiana Plan and expansion under the maintenance of effort. And so we do receive 90% federal match. So much of our reduction, enrollment variance due to the maintenance of effort, which is the third line down, is $128 million because the $1.3 billion is greatly reduced because of the 90% federal share on the expansion population. We also have the $265 million near the bottom for additional FFCRA funding at 6.2%. So those are kind of the highlights of that slide. And we have touched on the enrollment projections already. So unless there are any be more than happy to answer any additional questions. Oh, you're right, CHIP. CHIP funding, thank you, sorry. CHIP funding has varied, and so you can, in 2019 and 2020 and 2021, we've had enhanced CHIP funding from the federal government that is decreasing down to 76% in state fiscal year 2023. The state share has been increasing, will increase because of the decrease in the federal match. And so you can see that the appropriation to CHIP funding still does show a surplus. One of the things that I would highlight here with regard to the CHIP program under the maintenance of effort, CHIP children or Medicaid children are not moving from Medicaid to the CHIP program. Historically, children do move through the system of being Medicaid eligible and then becoming CHIP eligible as income changes for the families. However, under the maintenance of effort, children are staying under the Medicaid program until redetermination is made following the maintenance of effort. So there is that's how come our total expenditures, you can see in our total expenditures have been dropping from $262 million in state fiscal year 20 to $245 and then projected to $206. So that drop is because of our enrollment is staying under the Medicaid program and not being transitioned up into CHIP as their income changes. And so that's why our expenditures increase in 2023, because a lot of the children will have redeterminations, they'll be at a higher income level, and then they'll go into the CHIP program. Okay, thank you for the reminder.
Senator Brown.
Thank you, Mr. Chairman. So along that line, I was going to ask a question earlier. So when you were talking about the increased costs in 2023, is it because of, as we extend the maintenance of effort, people who are eligible under Medicaid, we will be paying for them in 2023 for 2022 costs that we no longer have the increased FMAP in 2023? Is that right? Did I say that right?
Yes. What I would like to, let me just clarify and then hopefully, so the reason that with the federal match, it ends on March 31st today. Right. However, our redeterminations will be a months-long process well past March 31st. They are still, there are federal regulations that may still change even on how those redeterminations and reviews will occur. And so because it will take multiple months to redetermine everyone, we're just, every month we're spending, and then we're spending at the same state or the lower federal match. And so by delaying it another quarter from January to April, that pushes that redetermination process from right now, we're anticipating it starting sometime in June, July. It pushes it another quarter later. So it just will add more months of enrollment for the individuals.
Okay, that's what I thought. And then a quick question with respect to the, along the line of the increased long-term care issues. And I know the agency is moving towards a managed care system. With some of this reserve fund, is there a thought to build into smoothing over that process? Because obviously there's a significant concern in the long-term care community about moving too quickly from the current model to managed care and figuring out the capacity of both an assisted living, home-based, and making sure we have appropriate wages for the home-based, but then also in the long-term care, because we still have to have sustainable institutions.
Yep, thank you for that. On the theme of smoothing over process, that is, we haven't talked about the reserve fund. Outside of that, we plan to leverage some of the HCBS spend plan and have started now. We actually started 12 months ago in active stakeholder engagement, business acumen training, provider resources. We are really trying to co-design to incorporate any efficiencies and streamlining that we can to improve provider experience, but also making sure we keep family member, caregiver, the patient, the participant really at the forefront of driving their care. And so I guess I just want to say we are taking very seriously all feedback, both from stakeholders and providers, and it's all about bridging that transition to managed care. So we're continuing to work on building capacity, evaluating current capacity, planning for the future. So that's kind of the very fabric of what we are doing. So.
Oh, I know I would like to continue to have that kind of information as you get it, because the concern is moving people eligible out of long-term care to assisted living, home-based care, and right now there is literally no capacity. There are no employees available. The wages are still an issue, particularly in the areas I mentioned that didn't get a wage increase. And so at the same time, if we move too quickly to managed care for long-term nursing care facilities, we can move them out of there, those that are eligible, and they literally will not get any care because there's no place for them to go.
And I really appreciate that comment. The goal is not to move individuals out of nursing homes. I think this could be. It could be. And I guess the opportunity with having, a greater focus on this is that we could hopefully help those individuals that are there that would prefer to be at home. Maybe we'll have the opportunity and interventions and be able to see them and help them. But this is very much kind of preventative. So what can we do before the nursing facility level of care? The individual is faced with a choice of heading into an institution. So that really is what this reform and managed long-term services supports is about. It's the care coordination to prevent that more costly and really long-term placement of the individual. That is where the opportunity is and where the investment is. So I think we should keep having conversations, because that is the exact information that I know you and your counterparts need, and we're committed to.
No, I appreciate that. And certainly the preventive piece, the aging population will appreciate that instead of waiting till the end. But when I hear streamline and efficiencies, there are still concerns and issues with the transportation piece that you run in terms of picking up those people who are going to appointments, who are receiving dollars somehow in some Medicaid program. So I just hope we really have checked all the boxes before we jump into the next one. But thank you, I appreciate that.
Absolutely.
Anyone else? Okay. Anything else to add? Allison? No? All right, well, thank you very much.
Thank you.
All right, we're going to take a 15-minute recess. we'll finish our last discussion item.
Thank you, Chairman Mishler, members of the committee. Good morning. I don't know how to follow the previous presentations, but I will give it my best shot here. I'm here this morning to give the periodic update on the COVID relief and recovery funding, primarily the CARES Act and the Coronavirus Relief Fund, and then updates on the American Rescue Plan that the General Assembly appropriated earlier this year. You have a brief packet. If you turn to the second slide, it's a stacked bar chart of how the $2.4 billion of the Coronavirus Relief Fund was allocated across major program areas. This was first in your packet back in June of 2021. And so, as you might recall, the Coronavirus Relief Fund was for medical, health, direct expenditures trying to fight the pandemic to be used very quickly. And it was supposed to be obligated and expended by the end of 2020, and that was extended through the end of this year, 2021. As you'll see, if you flip to the next page, there's been a little bit of a curveball thrown by the U.S. Treasury. We received updated guidance on Tuesday that said they recognized that the CRF was to be used for short-term needs and to address the immediate effects of the pandemic, but they recognize that those costs related to fighting the pandemic are continuing, and so they've redefined incurred cost, the phrase incurred cost, and what does that mean? It used to mean that the costs were incurred when the goods were delivered or services were rendered by a certain date, by December 31. They've changed that to say they deem the costs incurred if you've entered into an obligation for goods and services by December 31, but you can expend those after December 31, and in fact, all the way through September 30th of 2022. I don't think that necessarily changes a whole lot of what you saw on the stacked bar chart on the previous page. If you'll recall, their two biggest expenditure categories was really the public health response that was really focused with the Department of Health and FSSA, and the PPE marketplace that was stood up by IEDC. And then the economic and business relief program area was the highest at the $835 million. That was with the contribution to the UI Trust Fund, workforce programs, and IEDC small business and hospitality programs. It was intended all along, and the reason that was so high is that as much as agencies back in 2020 were trying to forecast out what their needs were going to be, that there's going to be some residual in some of these allocations. And so the intent was whatever residual was left, we would direct to the UI Trust Fund, because we had, at the time, I think, $1.4 billion of state funds were used to make our contributions for UI payments. And so we definitely had that ability to restore and replenish the UI Trust Fund. And so this new twist, if anything, we might see some movement between the public health response category and the residual, the amount of the residual going to the UI Trust Fund. And I see it and so this is going to be an effort with the budget agency working with the program areas to figure out, are there ongoing needs that need to be funded related to fighting the pandemic? And so if there's any adjustments, I would think it would probably be an FSSA We heard about some of the nursing facilities. They are working with nursing facilities that are COVID specific for those patients, and so they are helping cover the costs with those facilities. And then there's also Department of Health. While their original MOU was about $316 million, they've exhausted that amount, and there are some additional expenses related to ambulatory services, maybe some additional testing just because of the variants that have come up in the last couple of months, and so they do have additional costs. So we may be moving some of the amount that would otherwise go to the UI Trust Fund to cover those expenses. If we do that, after our research, we will come back to this body and tell you what those adjustments, will be. But that'll be ongoing, and again, where we were preparing for trying to work towards the reconciliation of a 1231, we found out 2 days ago that this is a change that we could consider, and so we're going to take the time to look at those opportunities moving forward. Slide 4 is, you've seen in previous presentations, is the appropriations that the General Assembly enacted in the last session. And what I'd like to do is just walk through a couple of those programs. At your October meeting up at Grace College, we touched on a few of those. I'd just like to give a few updates on some other programs. At that last meeting, we talked about the state police body cameras and equipment purchases and DOC. One of the things that were still under development were the body camera programs, the local grant programs. And so that application window will open in January next month for those communities. And the Homeland Security will be administering that. You may have heard earlier in the week the READY program that the IADC is administering, and that was the $500 million. They had appropriation, 17 applicants. The awards range from $5 to $50 million per region, and there's an estimated 800 projects in those applications. The broadband program, that was the $250 million appropriation. You may recall the details of that, the statutory details allowing for challenges when people put in grants, and obviously there's a competitive marketplace out there, and people are able to challenge that they were already providing service, or they were planning to provide service in certain areas. Okra is in the middle of working through those challenge phases, and the anticipated awards will be in April in 22. I'm going to talk a little bit more about the broadband program because there was additional funding called the Capital Projects Fund that relates to this, and so I'll touch on that in a little bit. Slide 6 is just hitting on some of our health grants that were appropriated. The mental health grants was, I think, $100 million. And they're focusing on building the mental health workforce, increasing access, and systems enhancements. The Department of Mental Health and Addiction has published their first RFP for grant opportunities. Responses are due the 1st of March, and with a program start date of July. And the first allocation is $25 million out of their $100 million appropriation. They came before and outlined, I think, maybe 4 or 5 different uses of that appropriation. The Health Challenge grants will be, their announcement for those grant opportunities is expected in January. And again, they have a summertime award and start date for those challenge grants. On slide 7 is a summary of the Capital Projects Fund, and we had, I think, touched on this in October that we had just received information on that. So that's $203 million, and it's really focused on broadband. And the 3 categories you see there: broadband infrastructure, the digital connectivity, which is really related to devices and technology, and then multi-purpose community facilities. Those are the eligible uses. And the broadband infrastructure is probably the closest to what is ongoing already, what Okra is already administering, and that is fiber, the last mile, getting connections to people's homes and other facilities. The application, so there's a separate process on this with U.S. Treasury, and there's an application process due December 27th. And that's basically saying, do you want the money? That's basically, that's all it is a portal. Each state goes in and you identify who your team members are and declare that you want the money. Then you submit a series of program plans, and that's when the funding would occur. They approve your program plans, and then you don't get the entire $203 million all at once. It's basically you submit your plan, you state how much, you could say you want the entire amount, or you could do it in phases and saying that we want a portion of it for these particular purposes. They evaluate it, give you the approval, and then send you the grant after that. Because we've already started on the $250 million that was appropriated this spring, our intent is to take our program guidelines for what Okra has already started and submit what we think would be eligible under these guidelines to get the sign off to say we can use this bucket of money for those purposes. There's a subsidy program that Okra is administering, and that's probably the one program that will not fit in these categories and will still need to use the appropriation that was granted before. But I think a lot of just the basic infrastructure grants that they're reviewing right now will fit into this new category. That will lead to probably some future discussions with you as far as if the money is eligible here under this bucket, then there might be other opportunities for freeing up those funds for other purposes out of the ARP that was appropriated last spring. I know that's really confusing, but that's where we are on that. And as we submit the plans, we'll come back and give you the updates on those submissions. The next slide, we've talked before about how the state was the conduit for providing funds out to communities with a populations less than 50,000. And those are the stats there. We are done with this first half. We asked for 4 30-day extensions, worked with AIM. Even AIM said, he goes, these last 32 entities just are not responding. And so we had to close the window on that. But when you look at 32 entities out of 542, and that we've got all but, $1.6 million out, we're pretty pleased with the response. And most of that money went out in the first 30 to 60 days that the window was open. The second installment will be similar to the state recovery fund that we've received, and that is that installment will come probably in June of 22. It's supposed to be 1 year after the very first one, and so that's the timing there. I guess the last program that I'd like to touch on, even though it's being administered completely at the Housing and Community Development Authority, is not coming through the budget agency and any of these appropriations. This is the emergency rental assistance. I think in October, I had mentioned about the 5 communities that could administer rent assistance programs on their own, and how the allocation from the federal government really just did not fit the demand that was out there. And so $123 million has been submitted to Treasury as far as reallocating that to, I think, primarily Marion, Fort Wayne, St. Joe, and Lake counties. And so those are still pending, but we're confident that those will be approved. Just also want to touch on the Housing Authority also has grants for counseling. And so they're planning on 2 awards to help people with housing stability and providing those services. And then finally, working with the Supreme Court on eviction diversion program. And so the Housing Authority has been very active there. And then particularly in Marion County, they've been making they've been showing up in person at the small claims court, and not that they've got their own little kiosk or anything over there, but as the cases are being brought up, the small claims court judge is directing them to say, you need to go visit these folks over in the back of the room before we proceed. And so that was received very, very positively, and it also is adding to the awareness of the program. And because there's a little bit of the confusion between Indy rents and what Marion County's programs are doing and this diversion program. So having that on-site access was very helpful. That's all I have for you today, and be happy to answer any questions you might have.
Questions? Senator Dora.
Chris, I just want to thank you first for last budget committee, or the one before, I had a couple of questions, and you have always been responsive and you follow up. So I appreciate you and for that. One of the questions I had two meetings ago was on childcare, and you shared with me a link from FSSA with the details, and I appreciate that. Today we heard earlier this morning from the overall forecast that childcare seems to be an important topic, especially as it relates to parents who might find that childcare is more expensive than the wages that they will earn at a certain job. I think my understanding, there's $540 million that was awarded to FSSA for specifically early childhood services. Is that true?
Yes, there's a substantial amount of money that went for early learning, and then also I think they're called child care stabilization grants.
Yes.
Right.
So I understand that FSSA will manage those administratively.
Yes.
How can we leverage those dollars in a way to systematically? So I went to the website, I looked at the frequently asked questions and who qualifies, who doesn't qualify, and so on. But given that this is a strategic long-term issue that impacts workforce development, is there a way to leverage the $540 million so that we can address the underlying issues of what we call, I think, 55 counties or 55% of Indiana's counties have child care deserts, so tying it to workforce development. Is there a plan? Will FSSA maybe or OMB put a plan of how these dollars will be used, and how can they address these child care deserts?
I have not been specifically involved in that, but I think that's a good point, and we can connect with FSSA on that opportunity.
I really appreciate it. Thank you. Thank you, Mr. Chair.
One thing I'll do real quick, again, Representative Hamilton's not here to remind me. I do want to say I did get a text from her today. She's at home sick, so wish her a speedy recovery. So we'll go around and introduce ourselves. Jessica, we'll start down here with you.
Sure. I'm Jessica Harmon with Legislative Services Agency.
Representing Bob Cherry, alternate for the House Republicans.
Senator Liz Brown from Allen County, District 15.
Rachel Bibler, Senate Majority Republican Caucus Fiscal Analyst.
A House Democrat Fiscal Analyst.
Representative Greg Porter, a voting member, Indianapolis.
Lisa Ackelberg, Deputy Budget Director.
Zach Jackson, the State Budget Director.
Krista Ricci, Senior Fiscal Analyst, Senate Republicans.
Ryan Mishler, Senate, North Central Indiana.
Tim Brown, House Representative, District 41.
Liza Bartlett Sherman, Fiscal Analyst for the House Republican Caucus.
Susan Preble, V Fiscal Analyst for the Senate Democrat Caucus.
I like that, the emphasis. Fadi Kodura, State Senator, representing Senate District 30, north side of Indy and south side of Hamilton County.
Good thing no one went to the Ohio State University, right? So we did things backwards. We did discussion items first. So now we'll actually start the meeting. So I'll call the meeting to order. You've got the minutes have been distributed. Are there any amendments to the minutes?
I move approval. Should I do both October and November minutes?
Please. All in favor? Aye. Those opposed? So now we have an agenda that's been distributed and released to the public. Is there any amendments to the agenda? All right, then the agenda is on the table for discussion. So we're going to start with the agency projects. We have Department of Transportation, Steve McAvoy.
Morning, Mr. Chairman, members of the committee. My name is Steve McAvoy. I'm the NDOT Statewide Facilities Director. We just have one project on the agenda today. We formally request funding in the amount of $450,000 for the architectural and engineering fee for the construction of a 7,000 square foot unit building and a 17,000 square foot salt building and a 5,000 square foot equipment storage building in Mishawaka, Indiana. The new unit building will replace an existing 1,800 square foot unit building that was built in 1967 and the existing South Bend Winter Operations site. So we'll be combining two sites into one here. The new salt building will replace the existing Mishawaka Salt Dome that was built in 1972. So both buildings will be constructed on a new site that we're in the process of buying right now in Mishawaka. So the existing unit building does not allow for OSHA-approved work clearances or proper ventilation within its garage spaces. In addition, the age and condition of the structures has contributed to other operational and environmental issues such as ADA accessibility, the inability to wash our trucks inside with containment, many site drainage and stormwater-related issues. The existing salt buildings do not allow for salt to be offloaded and loaded under roof and out of weather. Offloading and loading of salt outside in winter weather is unsafe and contributes to on-site salt contamination. Construction of the new unit building, salt building, and equipment storage building will mitigate these concerns while keeping in line with current industry standards for similar NDOT units and salt buildings. Upon completion of the new unit and salt building, the existing Mishawaka unit site and the South Bend winter site will be sold.
Any questions? All right, thank you.
Thank you.
There's a salt building every time we meet. We use a lot of salt, I guess, yeah. Next, we got State Police, Major Jerry Williams.
I'm sorry. And I talk low enough as it is, right? Again, good morning to everyone here this morning, here on behalf of Superintendent Carter to request a reallocation of capital funds to proceed with an HVAC project, which is the final phase of a 4-building HVAC upgrade system. This particular location is our facilities located out for 21st Street and Post Road. It currently houses our crimes against children as well as our long-term evidence storage location. The current system is approximately 40 years old, so we believe it has totally outlived its lifespan. And so we request a favorable consideration to reallocate those funds to finish up this final phase.
All right.
I'm sorry, Chairman. I just brought him for reinforcement.
Okay. All right. No questions? All right. Well, thank you very much.
Thank you.
Next, we have Office of Technology, Tracy Barnes.
Good morning, committee. Mr. Chairman, thank you for the opportunity to talk to you guys today about what we affectionately refer to as whole-of-state cybersecurity. We'll give a quick explanation of what that means and what we're looking and planning to do.
Whole of State Cybersecurity is really an opportunity or initiative focused on improving the state's overall position, working with political subdivisions and partnering across the state from a government municipality standpoint to ensure a higher level of cyber and digital protection for the entire state. It's an extension and realization that we can't truly focus on state technology and cybersecurity only within focusing on these 3 buildings of downtown Indianapolis. Our goal is to work with our local governments and municipalities and trying to help them prepare themselves for the future and understanding the current footprint and technology prowess that they have. Ultimately, the goal is to improve their posture and help them find ways to get additional funding for actual implementation. But what we're focusing on and asking for funding for today is to help them do some internal assessments and put together some cybersecurity plans to help identify where those gaps are, where those priorities are, and where those needs lie. The new federal infrastructure bill does provide funding for state and local government cybersecurity. One of the requirements for qualifying for that funding is to actually have a cybersecurity plan at your local municipality. Our goal is to go into those communities and help them create that plan and help prepare them for those requests for funding for that grant program as it's made available. Any questions?
Questions from the committee? Senator Brown.
Thank you, Mr. Chairman. So this is not assessing the state, it's assessing the locals, or is it both?
It's assessing the locals primarily, yes.
And if they don't want to participate?
It's not a mandate, it's
Right.
an optional offering. The access and the way the current funding is laid out for the infrastructure bill for the state local cybersecurity funding is that the funds will flow through the state of Indiana. So in order for us to be able to consider them, they'll have to have some level of plan that they can make available for us to consider and determine whether there's valid opportunity for that funding for them.
And is this just for municipalities or also like county-owned hospitals, anything related to a political entity?
So what we've been seeing is that from a county perspective, some counties have oversight of the health department, the court systems, some of the K-12 districts, and now it's a bit of a black hole as to from county to county what all they have oversight of. Our goal is for that county to represent themselves and talk to us holistically, whether it's the clerk's office, health department, courts, K-12. We are very open to going into expanding and talking to the K-12 separately, the courts separately, the health department separately if necessary. But again, a lot of that's going to be determined by what the actual activities are and ownership or responsibility is at each county's level.
Okay, I get that. And that's very helpful. I think that we heard anecdotally stories of hackers at very small municipal sites, small hospitals.
Exactly.
That then leads them in. Okay, thanks. Appreciate it.
You're welcome.
Representative Brown.
Thank you. This is phase 1. Phase 2 and phase 3, will they come quickly or will it be a year? How quickly will these 3 phases be done?
So technically this is more of phase 2 where we're actually going to create the plans. From the initial conversations we've had, we've been able to get some data from the local health departments to understand what they're looking for and what they need. What we don't have is the countywide and the cities and other municipalities. So our goal is to start this phase 2 and get these plans started first of the year. Phase 3 is somewhat contingent upon when the actual funds from the federal infrastructure bill become available. Their goal is to have some money available this federal fiscal year, which means hopefully before September of 2022. So if we can get plans prepared for some of the jurisdictions, they can start applying as soon as those plans are available, and we can start disseminating those funds, and hopefully they'll start implementing and deploying upgraded technology and new monitoring solutions before the end of 2022.
As we go forward in the phases, will there be more state money requests?
At this point, we don't anticipate there being an additional need for state money. Between the federal funds that are available, which will help with the actual implementation, some of it will be contingent upon how many of the jurisdictions are willing to work with us and partner with us in putting that plan together. But the funding that we're asking for, we're comfortable will provide a plan for each of the local jurisdictions that we're talking to.
Okay, thank you.
All right, thank you.
Thank you.
Next, we have the university projects. We have Ball State. Becca?
Good morning, Mr. Chairman, members of the committee. Thank you for the opportunity to come before you today. I am coming to you with a familiar project. Perhaps the last time I was with you all, we had asked for an original approval for our Grand Lawn Amphitheater, which we're now, because of a generous donation, calling the Brown Family Amphitheater. We heard this morning, of course, and in some of your prior committee meetings, you have talked a bit about the rising cost of projects, and so our cost of the project has risen from the original $3.15 million to $4.7 million, and so we have secured some additional donations and also seek to backfill what we'll spend in reserves temporarily with foundations to cover that cost. As a reminder, this was originally approved in April by the Budget Committee, and so the bid went out in June of this year, and just because of the cost, we rejected the bids and plan to go to bid soon, hopefully with your approval. Since that time also, I know that we talked a little bit this morning about the READY grants, the East Central Indiana regional plan did classify this as one of the catalyst projects for the region. I think that it's important for our community to have structures like an amphitheater where we can bring our community together. Of course, it really is for class purposes and for academic purposes, but the uses from our student activities and Welcome Week and orientation, and then combined with those community uses, are of growing importance in our region. So I wanted to highlight that for you all as well. It's a 4,646 square foot structure. It will have obviously sophisticated equipment for performances and those sorts of things, also public restrooms, and it will really bridge that gateway that goes from our Joanne Gora Wellness Center to the East Quad of campus. It will take the spot of the former Emmons parking structure, so it will fit nicely into our Grand Mall green space as well. Any questions?
Chris, questions for Becca? All right, seeing none, thank you.
Thank you.
Next, Alicia Knopfsinger, Purdue.
Thank you, Mr. Chairman, members of the committee. So the next three projects are Purdue capital projects. I believe the first one on the agenda is the biochemistry building. So we're seeking your approval for replacement of the electrical distribution system in our biochemistry building. It houses both the Department of Biochemistry and the Office of the Indiana State Chemist, which is a state regulatory agency for the agriculture industry. In the project, we would replace 2 transformers and 2 electrical distribution systems that are both very outdated. The original electrical system was installed in 1937. Some upgrades and some work was completed in 1981, but the transformers were not included in that scope. So these systems support power for equipment and lighting throughout the building. The project would replace the main switches, panels, and circuit breakers with new equipment. And in doing so, it would improve system reliability, allow for greater flexibility in the research lab equipment, and enhance maintenance technician safety. The estimated cost of the project is $2.3 million, and that would be funded from operating funds as part of Purdue's fiscal 22 repair and rehabilitation budget. So the next project we are seeking your approval of is the Schliemann Hall, Stewart Center, and related renovations project. This project would provide a home for our growing data science program while also enabling us to centralize student services on the West Lafayette campus. You might remember that in early 2020, Purdue actually brought a proposal for a new data science building. That proposal was approved by the Commission for Higher Ed in February of 2020. However, it was put on hold when the pandemic hit. Since then, we've taken a close look at what we've learned over the past 20 months, specifically at our successful use of both the hybrid and remote work arrangements. We've also stepped back and looked at where we can renovate existing space instead of building new buildings. With this examination, we determined that the needs of our data science program can be met with a full renovation and occupancy of Schliemann Hall. So in this project, we're achieving two outcomes with a combined project in a way that's more cost-effective than addressing each of these needs separately. So Schliemann currently houses a wide range of student services that include enrollment management, financial aid, and the registrar. Because we're renovating Schliemann for the data science project, we would then be moving these student services functions out of the building and modernizing 3 floors of the Stewart Center building to create a new student services corridor where current and prospective students can access key services. The Schliemann Hall residents that interact directly with students would move to the Stewart Center, and then the other functions that do not involve direct interaction with students would be moved to other spaces on campus. There's a number of benefits to the project. First, by renovating Schliemann, we will be moving the data science program to a location that is convenient to other College of Science facilities, and we will avoid the increase in operating costs that come with the construction of a new building. Second, by relocating student services from Schliemann into the Stewart Center space, we will optimize student experience by allowing students to access a number of these services and resources in one central location rather than having to go throughout campus. The estimated cost of the project is $52.8 million. That's with $47.8 million provided by operating reserve funds and $5 million coming from gift funds. We would seek to start construction in August of 2022 with a completion date of May 2024. Okay. Last project, Purdue is seeking your approval for replacement of mechanical systems in Whistler Hall. It's an agricultural building that houses the work of researchers from 5 departments within the College of Agriculture. The project will install 3 new air handling units and replace the heating system and exhaust fans. In addition, we'll make changes to plumbing and electrical systems that are related to these new systems. With the work, it will improve reliability through the modernization of the building's mechanical systems. We'll also be able to meet updated standards for temperature control and ventilation in the labs. Lastly, the project is expected to save us approximately $60,000 per year in energy costs and $10,000 per year in HVAC maintenance costs. The estimated cost of the total project is $12.5 million and will be funded by our state R&R appropriation as well as operating funds.
All right, thank you. That is the last project. So we'll move to the review items. We'll start with Ryan Vaughn in Indiana Sports Corp.
Thank you, Mr. Chairman, members of the committee. My name is Ryan Vaughn, the president of Indiana Sports Corp, joined today by Shannon Sullivan, our director of statewide events, to report out on the annual grant appropriation you all afford us to manage on behalf of events statewide. As a quick reminder, $150,000 of that $550 is dedicated to the state's part of the Big Ten Partnership. The Big Ten Community Partnership is a partnership between the state, the city, the Capital Improvement Board, Indiana Sports Corp, Visit Indy, the Pacers, and the Colts, all of which goes to fund rights fees for the opportunity to host these events. This past year was a little bit of an interesting proposition for us. We were able to host the Big Ten Women's Tournament as scheduled at Gainbridge Fieldhouse. The Big Ten Men's Basketball Tournament, which was originally scheduled to take place at the United Center in Chicago, was actually relocated to Lucas Oil Stadium as a prelude to March Madness in the Final Four. And then just a couple weekends ago, we concluded this year's work with the Big Ten by hosting the Big Ten Football Championship. That was actually at full capacity, which was fantastic. It was the second largest crowd for a football game in Lucas Oil Stadium, only behind the Super Bowl. So a lot of great things are happening with the Big Ten. We are in a current active bid process with the Big Ten to host future events. The athletic directors are actually meeting tomorrow. We anticipate a decision in the first quarter of next year. We have bid to host the Big Ten Football Championship for every year through 2025, and we have bid to host the Women and Men's Tournament in 2025. The remainder of the grant is appropriated for attracting events not only to Indianapolis but statewide. That activity, even in the midst of the pandemic, has been been happening. Shannon and her colleagues have attended multiple trade shows and events, meeting with rights holders. We have a variety of active bids out there, including NFL draft opportunity, international swimming competition, the opportunity to host the U.S. Olympic trials for swimming, which would actually take place in Lucas Oil Stadium, which would be very unique. USA Track and Field Half Marathon National Championship, a rather novel event for us, which we're in the middle of, the opportunity to potentially host the entire season for the NBA 2K, which if you're not familiar with NBA 2K, it is the esports version of NBA basketball. 24 teams from across the country would actually relocate to the city of Indianapolis and compete in a series of tournaments over 5 months, which would be pretty outstanding for us. So I think Shannon passed out something to you all as well. This particular graph here is just a total impact statement for what's happened just in Indianapolis, and then I'll turn it over to Shannon to speak more broadly. But as you can see, a bit of a mixed bag. Of course, we've hosted a number of events. Many of those were at reduced capacity. However, there were a number of events that we were not scheduled to host that we were able to host because we were able to operate at a limited capacity, and not the least of which was the entire March Madness tournament in men's Final Four. So it's been a good year for us, all things considered, in Indy. And I'll turn it over to Shannon unless anyone has questions.
Right. Moving on to Team Indiana, $150,000 of our total allotment is dedicated to Team Indiana and the statewide initiatives. And Indiana Sports Corp leads and manages that effort to help better sustain and propel sports tourism efforts that are happening across the state. Quick overview of Team Indiana. This group represents more than 20 destinations across the state, from all corners of the state. We've actually been able to engage with 4 new destinations this year who are starting to participate in sports tourism or are building or at the beginning stages of building sports complexes in their communities that they want to be able to activate. And so our group really works together in a collaborative effort to share best practices, provide leads, and work together to promote the entire state as a great place for hosting sporting events. Specifically, a portion of our funding is dedicated to community event and bid support. So we operate a grant program. 8 members of those Team Indiana communities sit on the grant program to review all applications that come through and make the awards. In the packet I passed out, there is a listing of all the applications that were reviewed this year. We are still seeing some impact of COVID with some events relocating or being canceled or postponed. So we had a little bit of movement of events being approved and then canceled, and so more money was available. And that's why our list is rather long. But you'll see that we reviewed a total of 30 applications requesting more than $330,000. Of the $114,000 that we had available to support, we were able to provide grant funding to 22 events that spanned 10 counties across the state. And also in your packet is a snapshot of that grant impact. Those 22 events resulted in a total impact of $10.3 million, as well as nearly 27,000 contracted rooms picked up. That's also just a small portion of the actual rooms that are happening, as we know that people go outside of the blocks where things are not always tracked. And just, I would like to remind that, this only captures the impact of 22 events that are happening in the state. When we think about the whole year across all of our counties, that is just such a small glimpse of the actual impact sports tourism has on Indiana. Additionally, a portion of our funding is used for the marketing and promotion efforts of Team Indiana. This year, we were excited to be able to get back to in-person trade shows, especially after last year. Most of those were canceled or virtual. And so we invested a lot in being able to have a presence there and sponsorship at those. Those are opportunities to meet with event owners, build relationships, learn about bids. And so at our most recent trade show in October, we had 12 communities represented, and we were able to host some event owners and some relationship building activities. We also use those funds to help with marketing efforts, digital ads, e-blasts, newsletters, and things like that, as well as creating facility guides and promotional materials that can be used by our members and then also as the organization as a whole in attracting event owners to the state. So if you have any questions.
You know, Ryan, I want to commend you and your group over there. You know, I look at this as the $550,000 we invest in Sports Corp. I look at the numbers these events bring in, and I have to tell you that $550,000 dollar for dollar is probably one of the best investments that we make as a state. So thank you for what you do.
So thank you, and we appreciate the support.
Senator Brown.
Thank you, Mr. Chairman. Yes, thank you. I appreciate all the information. I'm just curious how many Paralympic events that you have marketed to and reached out to and put bids into?
Indianapolis specific or?
No, for the state.
For the state. Fort Wayne is our leader in the Paralympic and adaptive sports movement. Not this year we did not have any events that we supported. I think it was last year and the years before, though, that we have supported a few events that have gone through Turnstone and some various international events that they posted. I'd have to pull back our records from those years to be able to share.
Yes, that's up in my area, and that is the only Paralympic training site in the state of Indiana, up in Fort Wayne. So I would just put a pitch in for a little more support because I don't see any mention of Paralympians anywhere in your materials. And I know recently our governor made a pitch for having a partnership with the country of Qatar, which also has a robust Paralympian sports program. So it would certainly be much appreciated if they were mentioned in the materials specifically. And obviously, up in my neck of the woods, those facilities are already in place, including year-round training and residential facilities, unlike any other place in the state, Olympian, Paralympian, elsewhere. So I hope next time it's on your radar in your materials.
I'll be happy to share with you some of the promotional materials and things that we put out in publications, because that is one of the things we're very proud of and that we highlight often, that, you know, Indiana and Fort Wayne specifically is one of, I think it's only 15 official U.S. Olympic and Paralympic Committee designated training sites. And so that is a real feather in our cap that we like to promote to the event owners and in our publications. The grants that are listed, those are up to the communities and the venues that they work with to apply for grants, and we do work with Visit Fort Wayne and Turnstone often. I know sometimes they are strategic about which things they are putting in grants for, if they have funding coming for other places, if there are limited funds. So sometimes communities will not apply for one event because they have a bigger request coming in a later year. But we will talk with them again. And
well, I hope you consider them annually because they are Paralympic training requests. Their needs are current and ongoing, and they continue to grow because they've also hosted JoJo. So thank you. I appreciate that.
Thanks.
Zach.
Thank you, Mr. Chairman. Could you give me just an idea of what your total budget is like? I know the state contributes that $550,000 that Senator Mishler mentioned, but what's your overall budget look like, and what are those other sources of funding?
We're about a $10 million organization. We have obviously funding from you. We have some funding from the Capital Improvement Board at similar amount, $500,000, and the rest is all privately raised. So it's either raised through sponsorships and events that we own and host, or you can be an individual or corporate member of Indiana Sports Corp, and depending on your contribution level, certain benefits follow.
Thank you.
Thank you, Mr. Chairman. Ryan, come January 10th, is something happening here that I haven't heard you mention yet, in conjunction with the Sports Corp and the college football playoffs or something?
Yeah, a great event, college football national championship, will take place on January 10th. It'll actually be a really kind of a 4-day celebration. The game is on Monday night. I hope you all can come down and enjoy it. But the first quarter of the year is actually really packed with events as well. So not only do we have the championship, We have the Horizon League men's and women's tournament. Big Ten men and women's are back again. Division III national championship and in the NCAA first and second rounds, all in March. So if you crave any basketball, we have just as much ahead of us as we have behind us, I think. So.
Thank you.
Thank you. Appreciate it.
Next, Allison, you couldn't leave us, could you? FSSA.
All right, thank you for the opportunity. Again, Allison Taylor, Director of the Office of Medicaid Policy and Planning within the Family and Social Services Administration. We have 2 items today in terms of state plan and waiver amendment review. The first one relates to our non-emergency medical transportation state plan amendment. And so there's no fiscal impact. There was a Consolidated Appropriations Act that passed in 2021 that had required states to amend their state plan amendments, which is our contract with the federal government to administer the program, and required actually just reporting of putting some requirements that we already have in the program, but actually in the language of the state plan amendment. So you'll see the 4 additional items. It's just addition to the state plan amendment pages. And because we're amending that contract, bringing it today to you for review. The next one is a amendment to our age and disabled waiver. So there are a handful of items. I will try to do my Division of Aging partners justice because they've worked so hard on these, and I will hit them in order that I think they're listed. First, assisted living. So we are making seeking an amendment to, I'm sorry, back it up. Assisted living, this is a reimbursement increase that was required by House Enrolled Act 1001, effective July 1st, 2021. Rates have been increased by 3.9%. In addition, there's a 4.6 temporary increase effective January 1st, 2022 through June 30, 2022. The second item, the Division of Aging is seeking to add 2 additional services to the waiver. They are goal engagement and caregiver coaching and behavioral management support. These are services that will help individuals really remain in the community, and the team is really excited to add those. The third item is participant-directed home care services. So this is a really small pilot program that is available in select zip codes, and it allows an individual to have self-direction for not just personal care, but for skilled care, so those with higher needs. And the purpose of this is to really evaluate. We're hoping to get a few more folks in the program over time and evaluate and maybe get some assurance that a higher level of skill need could be appropriately managed at home. Fourth, the Division of Aging and FSSA are seeking the addition of waiver slots to the A&D waiver. We heard earlier there's been a natural growth in individuals choosing home and community-based services, so we would like to increase our waiver slots to, I think we're at about 39,000 now, looking to move to 40,000 and then 47,000 over the coming years. And then let's see, the last piece is we are seeking to clarify and sort of adjust the scenarios where an attendant care aide is allowed to transport a client to medical appointments. So we are making some clarifications in statute that this can occur for these waiver recipients. And so those changes took effect May 1st, 2021. And again, will help those individuals get where they need to go. So that's the package from Division of Aging of state plan amendment waivers or amendments.
Thank you very much. You mentioned the zip codes, and when you talk about the programs, what zip codes are they going to be, and how are you going to choose those zip codes?
So that's a good question. Let me see if I have any helpful information.
Or is it going to be is it going to be statewide, right? Or is it
From a pilot perspective, no,
yes.
it is not ready for statewide yet because we are, I think the goal is to pilot and examine sort of the opportunity to provide skilled nursing level at home. And so definitely want to grow that incrementally before it is turned on statewide. And I know I've got just a couple of more notes. I think this is just an opportunity for us and stakeholders to really proof of concept.
Okay, I'd like to follow up with you on that.
Yeah.
And my other question would be, due to the fact that we've heard of a nursing shortage, so where would we might get these individuals, the nurses? I mean, I know people are now doing contract nursing. I have people from Valparaiso coming down here, staying 3 or 4 days to work at a hospital, then going back home on the weekend, something like that. So I mean, we have these great ideas, which are very meaningful and important to keep people in their homes. But are we creating a pipeline to help those nurses help backfill those leaks in our nursing community?
Yeah, thanks for that. On I think the self-direction piece, and again, we'll follow up on the zip codes and exactly what the team involved there looks like. Your comment on nursing pipeline, provider pipeline, I can just say, I appreciate that. We are, through our LTSS reform work specifically, one of our key drivers and results is provider pipeline, recruitment, retention, workforce. And I know there's nursing in particular, there's not just our effort, but I think there's multiple groups looking at it. So I hear you, and it's really important for us, and we are going to continue to partner with higher ed, licensing, Department of Health, and see what we can do to improve there.
And last but not least, what number we talk about in regards to the pilot? How many?
In the pilot, we have 1 individual right now, and there's indication we would like to get like 5 to 10 as we go.
Servicing, okay.
One individual now, up to 5 to 10 individuals.
Okay.
Yep. Early stages, but we'll connect on some of the information there. Okay, thank you so much. Oh, I'm sorry, I have one more item, the HIP closure fund. Okay, I thought you said get out of here. I saw the hand. But wait. Okay, yes, quick. All right, so this is our final item. In partnership with the Indiana Hospital Association, we are seeking suspension of the Healthy Indiana Plan phase-out payment. So you'll recall we did this in 2019 and 2020. The hospitals have paid into the closure fund for year 17 and 18. We believe this is, especially important this year given stress of the pandemic response on hospitals. So I think I'll pause there, and I have additional information prepared if you wanted me to go into more detail on it, but.
I do have a question. So
Sure.
As the cigarette tax, and you don't have to give the numbers now, I assume the cigarette tax revenue may be going down. The goal would be actually for it to go down, right? And so is the plan originally that the HAF, the hospital assessment fee, would increase to match what's lost from the cigarette tax refund? That's probably not a question for you. That's probably,
I know, I'm kind of looking at the commercial.
okay, and so just to be clear, the hospital assessment fee, which is $358 million plus or minus, and then the cigarette tax, but you're only suspending the phase out of about 11 and a half over these.
Yes, so the hospitals.
19, 20, and then 2021.
Yes, we put aside 11.5 million, the hospitals do, and it's not needed this year and would rather that stay in the program, so yes.
Thank you.
All right.
Okay.
Thank you.
Thank you.
Next, we have the Indiana State Police, Major Charles Soros.
Good morning, Mr. Chairman, committee. Thank you for having us this morning. With me is Captain Shay Rutherford. To my immediate right, I'll introduce my other team members. Have Lieutenant Ronell Williams, who's our benefits manager or benefits commander. Have Phil Loftus from McCready One America as our actuary for the OPEB. And then Marcus Bowling from LHD, who is our consultant on the insurance plan. Thank you for having us this morning. Again, the time was noted here just a minute ago, so I'll be brief in my comments, but hopefully thorough. As you see on the outline that we provided, we have no plan changes planned for 2022. And on the next page, and I'll just bring this forward because it's probably one of the most important parts here, is none of the ISP plans or our current plan designs increase the OPEB liability at all, and actually they decrease it. And I'll touch on that more here in just a minute. We have a number of things that we have targeted, particularly in response to the committee's guidance to us here a few years ago, where we looked at diabetes, cardiac issues, hypertension, different things that cause long-term effects and negative effects on the human body and cost. And we have been successful in that, and I'll give you a few points that'll show that. If you look at the fifth bullet down where we restructured our wellness plan, originally we had a gym reimbursement program in place there, and that was actually limiting. While it was a good step forward, a good initial step forward, it was very limiting because we had people that own home gyms. We have people that have ambulatory problems that can't get to a gym. And so they do home workouts or they do other types of workouts. And so what we did is we transitioned to a tobacco and vaping cessation and a annual physical to qualify for the program. And you have to do both. So we want to make sure that the people are getting to the doctors on an annual basis. And with that, to have the premium credit, you have to have also the tobacco attestation for cessation or the education program. So we have steps involved there. If somebody isn't able to quit, we have a program in place where they can go to get an education to get their first steps in there and hopefully move forward to a point where they are no longer using those products. With that said, we are experiencing, I'm trying to find the bullet point here. Excuse me, I had it highlighted here somewhere. Okay. This is where I'll kind of tie a bow on some of that there. So under the second page, the first bullets here where it talks about the OPEB, you'll see where our actual plan experience exceeds national averages of increases of 6.6 to 7% is the national average. We're at 0 to 2% in plan increased in costs, okay? So we're well below the benchmark there, but what we also are experiencing is a 5.6% increase in utilization. So we've got more people using the plan and fewer costs coming out, which means we're catching things early. We have people engaged on an annual basis in their health, which is the number one thing. To engage a physician on a continuous annual basis is the number one factor to reducing long-term ailments and costs associated with them. So with that said, we are also under benchmark, or our inpatient hospitalizations are down as well. So there's cost savings all across the board that are tied in to those various bullets. Is there any questions on any of that I've covered so far? Yes, Ms.
Senator Brown.
Thank you, Mr. Chairman. Yes, just real quickly, I see that you have CVS rebates last 2 years, $6.2 million
Yes,
in your
ma'am.
prescription plan. So Does your plan allow you to see the transparency of all of those rebates, or they just record them back to you? In other words, do you know the prices? Do you see the spread pricing? Do they share that information with you, or they just tell you these are the rebates you've received?
I believe we can get that granular level if needed, but when we get it back, it is in the form of a rebate. And I can't tell you exactly. Maybe Marcus can touch on that for us here real quick.
Senator Brown, Indiana State Police participates in the Indiana Agri Pharmacy Purchasing Program, which is a contract held by the state of Indiana. So the same visibility the police has the state of Indiana, as well as the public university. So not knowing specifically what items you're looking at, I couldn't tell you that, yes, we received that. But I think the takeaway is that the state police participates on that. All the entities together.
Okay, it would be nice, I mean, you don't have to, I can ask then from the higher beings that be, if they're just getting the rebate number or if they're actually seeing the actual prices. Because if they discount it, there's no rebate. So there's lots of moving parts in this, and we're all looking for the transparency because these are significant costs. I mean, good for the savings, but prescription drugs tend to be the most. So thank you.
Running a quick note, ma'am. Okay. So anybody else have questions so far?
Any other questions?
Okay, so moving on forward to the NIHART study on the OPEB for our funded status wasn't completed when there was amendments going to it when we submitted this. And since that time, we've received the final version of the NIHART report, which reflects as of June 30th, 2021, our OPEB fund stands at 100.5% funded. So we're in a really good position there. Just for historical purposes, if you look at like an official start date, when the GASB rules changed and we were given this OPEB liability, it was on July 1, 2011, and our first actuarial assumptions and projections at that time said we wouldn't reach a fully funded status until 2047. So we've actually knocked off 27 years off of the initial projections. So we've tried to do everything we can to meet that responsibility and reduce it as quickly as we possibly could. We, just one other thing of note, we go to a RFP for our insurance program beginning in the first quarter of 2022, and we plan to have that completed and in place by the end of the second quarter of 2022, and then it'll be effective January 1, 2023.
Any questions? Thank you.
Sir, just if you'd indulge me for just 1 minute, at the PMOC committee, I took the opportunity to thank the legislators in the room for the hazard pay that was afforded to the troopers last year, and also for the matrix increase that's going to be upon us here in July. But the hazard pay was something that was unprecedented, and while it was monetary, it actually reflects something deeper from each of you, and it meant something to our troopers, and I really appreciate it very, very much. Thank you all.
Next, we have Department of Natural Resources, Keith Din.
Good morning. Good afternoon. My backup is Mike Smith, short timer. Sure.
Both apply.
All right, I'm the committee chairman for the Excise Police Officers and Indiana Conservation Officers and Health Insurance Plan. And to keep it short, sweet, if you will, as far as any changes that are occurring to the plan, they're based upon some issues such as COVID and other ongoing issues. We have decided not to make any changes to the plan, so Indiana conservation officers and excise police officers will have the same plan in 2022 as they did in 2021, and based also on a viable and ongoing appropriate amount of reserve funds, we've also decided not to raise our premiums. As far as the OPEB liability, which is first and foremost for us, in the last 3 years, we've cut our OPEB liability in half, and we're currently on a 15-year glide path for fully funded. And that's based upon the Treasurer's team more aggressively investing our funds, our OPEB 115 trust funds, and within the current parameters, in a short period this last summer, we've been able to add approximately $1.695 million to our market value in as far as interest is concerned. So we're on a decent glide path. The discount rate was readjusted, and we'll continue to make that a primary focus for us. So again, a 15-year glide path to being fully funded. The only minor change to the plan was in the area of wellness. We're adding a program called Hello Heart. We have some cardiovascular vulnerable folks, and it's a ability to track voluntarily their blood pressure issues, and that's proposed to decrease the amount of claims in that area about 1.5 million. So a good program for us in the wellness area, and that is all I have pursuant to your questions.
Any questions? Seeing none, going to turn it over to Director Jackson.
Mike, I missed the last budget committee meeting, so I didn't get a chance to, I don't know if they harassed you or praised you, but I want to try to get in both this morning. But Mike, how long have you been with state government?
My first job was 1977, so 40 plus years.
So I know Mike started off at the Veterans Home on the mowing or maintenance crew, and 10 years at State Police, something along those lines, 10 years at Budget, 10 years at DNR. Yeah, traffic safety, I think something along those lines. So, I've known you for the past 17 years, and you've been a friend and a mentor for all that time, and just want to thank you for all these years of service and your friendship, and you'll definitely be missed at the Budget Agency and Budget Committee, but just want to say thank you.
My pleasure. Thank you.
Marian University, we have Kyle Hattenberg. Now you got to follow this up now.
Of the State Budget Committee. Thank you for giving me the opportunity to speak with you today about the Indiana Primary Care Scholarship. My name is Kyle Hattenberg. I serve as the Director of Enrollment Management at Marian University College of Osteopathic Medicine. In our first 5 classes, as of May 2021, we have graduated over 700 new osteopathic medical students. Of those, 195 have participated in the Primary Care Scholarship Program. Specifically for all of our graduates, in our first 5 classes, primary care areas of family medicine, internal medicine, OBGYN, pediatrics, and general psychiatry rank in the top 7 specialty areas of our students completing residencies in. So far this year, as of 11/15/2021, we have awarded 143 scholarships totaling $1.6 million. We expect that the number to rise to 151 scholarships awarded by the end of this academic year, as stated in our request letter under the 21-22 academic year projection header. Overall, the decision to incentivize students to work in primary care and serve the state of Indiana after graduation has been overwhelmingly positive. One of our core missions at the College of Medicine is to produce more primary care physicians for the state of Indiana. Annually, more than half of our incoming students are residents of the state of Indiana. If you look at osteopathic physicians nationally, nearly 57% practice in primary care, and for Marion, over 60% of our students have gone on to residencies in primary care medicine. So we are trending towards producing primary care physicians higher than the national rate. With that, I'm happy to answer any questions.
Any questions? Senator Brown.
Thank you. I just want to thank you for the information and the questions. I had them. I would just say in terms of compliance, because if they don't return to Indiana, then if they've left, they need to pay back the scholarship they
Absolutely.
received. So I appreciate getting all those numbers. I would just say, though, in question number 5, it says, of the graduating med students, how many pursued a residency in Indiana but didn't match into one? You say because of residency placements, you're not allowed to have that information. But you could inquire of your students. I mean, I think the match is usually in April, isn't it, before they graduate?
That is correct, yes.
Right. So if you could keep that information going forward, because obviously we're funding these students to become physicians, hopefully stay in the state. Obviously, sometimes for a lot of reasons, they'll match out of state. But it would be nice to know how many students have actually applied for residencies within the state and then didn't actually match, because they tend to end up staying where their final residency is. And so if they leave, then we might not get them back. But with that being said, you're probably very aware that up in my neck of the woods, we are expanding residencies. The hospital systems are funding it for psychiatry, eventually family practice, general surgery, internal medicine. So we'll look forward to seeing some of your graduates up there.
Absolutely.
Thank you.
Representative Porter.
Thank you, Mr. Chairman. Again, my question would be, the original intent of the program with Dr. Brown put together was to individuals go to disadvantaged areas. What is the percentage of that occurring right now? It was part of the language, then it was mysteriously removed. So do you have those numbers? And also, just to follow up on that, your number 7 of the 6% that are participating in the scholarship program, underrepresented in medicine. What are the demographics of those students again? Which question I've asked on 3 different occasions. Yet still, you hear the answer, but yet still you say we don't do it that way. Well, you need to do it. You need to calculate it that way. So I'm trying to help you get me information that I like to have, or I will continue to ask the question.
Absolutely. So to question 6, of the 6%, 3.5% are from African American, and 2.5% is Hispanic Latino. So we are trying to increase those numbers, but that would be the answer to number 6. I do not have the answers to your other question, but I certainly can work on getting that. It is not the language that's in there, as you had stated, that.
But that was the original intent.
Yep.
Of the language was originally in there. Then somebody took it out.
And I wasn't there.
I know you. I'm not blaming you, because you don't have the power to take it out.
Yep.
Legislators do. Who set policy. So it was done in the dark of the night.
No?
I'm done.
All right, thank you.
Thank you.
All right, are there any motions to move items to the agenda?
Mr. Chairman, I move the agenda be adopted.
You can't. Oh, yeah, Eddie's not here. I'm sorry. Okay, thank you. So all in favor of the agenda, say aye. Aye. Those opposed? All right. Anybody have anything to say?
Merry Christmas.
All right. As well. All right. We'll adjourn. Thank you.